on the rise. shake off Europe's spike in infections. And Deutsche Börse proposes increasing the size of the DAX. The index owner wants to expand the German benchmark from 30 to 40 members with conditions. Matt.
Yeah, let's take a look at what's going on in terms of futures right now. Still pointing higher across European equity indexes, and indeed FTSE futures are climbing to their highest levels of the session, up 1.2% right now. Euro Stoxx 50 and DAX futures are each up a little bit more than 0.8%. Let's take a look at the global macro movers screen. This shows you a slew of risk assets across a number of columns here. The far left column is the live equity index trade, and you can see that the FTSE has already opened up 0.4% and climbing, now up 0.5%. So it looks like, at least in London, we have some positive market sentiment to kick off the week. There you can see Madrid's IBEX opened right at the top, up 0.9%, and the CAC 40 is open as well, up 0.8%. So continental indexes, as well as the main index in the UK, are hovering around 1% gains right now, and you can expect to see that really across Europe this morning. So we do see gains there. As we get headlines from Ursula von der Leyen, she is self-isolating until tomorrow morning. The EU president tested negative on Thursday and was tested again today, but currently self-isolating as we focus on COVID cases amongst the most powerful people in the world. Anna?
Yeah, absolutely. And she says here that she participated in a meeting. I think this is what this flash is getting at. She participated in a meeting with somebody who tested positive, which is why she's behaving with this caution right now. 1 minute then into the European equity trading day, and we are seeing gains up by 0.9%, and some of this optimism coming based on the latest updates around President Trump's health. Let's talk about that now. His health remains under scrutiny, of course, as he stays in hospital for COVID-19 treatment. The president's doctors raised the prospect that he could be discharged, though, as early as today. There are many questions, though, over the seriousness of his illness and the timing. Bloomberg's Kayleigh Lyons joins us now from New York. Bring us up to date, then. What are the latest news lines surrounding his health, Kayleigh?
Well, his medical team held a news conference on Sunday. They said he was doing well, improving, and, as you say, could be discharged as soon as later today. But there were a lot of things they didn't say, specifics about his lungs, about his oxygen levels. And one thing White House physician Sean Conley said specifically was that the president did indeed need supplemental oxygen on Friday. He previously said that he was not receiving that oxygen treatment. As far as the other treatments, we know the president is getting or has gotten. He is on a 5-day regimen of an antibody treatment from Regeneron, from Desivir, from Gilead, which is an antiviral drug. And he's also been given dexamethasone, which is a steroid. And that is where we kind of get into this contradiction, Anna, because the steroid that he has been put on is usually used at later stages of virus in more severe patients. So doctors outside of the president's own medical team say that could mean the illness is actually progressing a lot quicker than expected. So that's where we get kind of this inconsistency between the treatments that the president is getting and this upbeat tone his doctors are painting. So a lot of question marks still here, and we will see if he is indeed discharged later today.
All right, so even without being discharged, the president apparently drove out of the hospital with his motorcade yesterday to greet his supporters. He was wearing a mask. Obviously, he was in an SUV, but he's received some flack for that drive.
Yeah, he has, specifically from critics in the medical community who say that by doing that drive, he was endangering his staff, his Secret Service agents, and once again, just not taking the virus with the seriousness that it deserves. As you say, he was wearing a mask. He was in the motorcade. The Secret Service said all safety protocols were followed, but nonetheless, he has gotten some negative attention for it. What he was likely trying to do by going out and waving and showing face to his supporters was really just that, getting out in front of the American people, showing them that he is doing okay, because they aren't really seeing him in public at any campaign events or anything, and probably won't for the next week or so.
Kaylee, thanks very much. Thanks for the update. Kaylee will be joining us again through programming, of course, with updates about the President's health. Joining us there from New York. Joining us now here in London, Bill Dinning, Waverton Investment Management CIO. Bill, very good to have you on the program. Clearly, we're going to be focused in the short term on the health of the President of the US. Has his illness, his fight against COVID-19, has it reshaped your thinking around the US election and the impact that's going to have on investments?
Well, I certainly think the election to us has been one of the things in the background that I think, given the consistency of the lead that Joe Biden's had in polls, the consistency of the lead he's had in the betting markets, we've sort of been looking for signs that the market is thinking about some of the consequences of a Democrat administration. Personally, I would think that the president's unfortunately getting COVID does put COVID back at the center of the campaign. One of the things that the president was trying to do was to move away from that and focus more on the economy and the recovery. So the job market improving, etc. But this obviously puts the virus right back at the center of it, and that's probably not good for him, given how his approval rating dropped significantly in the spring when the virus first appeared.
Although we have seen approval ratings of both Bolsonaro and Johnson skyrocket after they got the disease, the president seems to be taking some lessons from this, and it does look like he's on the mend now. He took a drive yesterday. One of his doctors, a very serious expert from the Johns Hopkins school, said that he could be released as early as today. Are you done, incessantly checking your phone for President Trump health updates, Bill?
Well, I do follow him on Twitter, so it's not necessarily the news organizations that need to help us, but we know that obviously this is going to still be a focus, particularly while he's in hospital. Obviously, a lot of conflicting stories over the weekend about exactly when he got it. There's stories that he had a positive test that he didn't tell anybody about right before he had a more comprehensive test that he did tell people about. So I think there's a little bit of confusion about exactly what's going on. But, obviously we don't wish anybody anything but better health. So if he gets out today, that will be good. But I think in terms of the reaction, I think this is slightly different than was the case certainly of Prime Minister Boris Johnson here. I think there was genuine sympathy for him, but, he hadn't taken the approach that the president has taken. The president has been very skeptical about what he calls the China virus. Even at the debate last week in Cleveland, his staffers and his family did not want to wear masks in the Cleveland clinic, whereas the Biden family and the Democrats in it at present did wear masks, as the Cleveland clinic wanted them to do. So to be as dismissive as he appears to have been on occasion about the virus, and then to actually have it affect not just him and the First Lady, but so many of his staff, I think is a slightly different scenario than one where you have a Prime Minister who's been battling this and personally gets it. So it may well be that his approval rating ticks up a bit. Whether or not this is going to get enough sympathy to change the polling picture, which looks, as I said, as though Biden has a solid lead, I'd be rather skeptical about that.
Okay, and of course we focus also on the underlying health of the economy in those various locations, Bill. I just want to refer to a red headline across the Bloomberg that tells me that Cineworld's shares have opened, and the Cineworld chain, then the share price there down now by 57% compared to the close on Friday. This after the news that they plan to shut UK and US theatres. Certain releases have been delayed, including James Bond. But really this part and substantial job losses, they're talking about 43,000 job losses as a result of this. And Bill, this helps us raise questions about the state of the economy in the US. And this links with President Trump's health, because he's been tweeting, as you say, from his hospital bed, or at least from his hospital quarters. And he's been talking about fiscal stimulus and the need for fiscal stimulus to try and get businesses through this. Do you see any real change in the fiscal debate in the US as a result of the president's condition?
Well, I do have some. I think there is a possibility that we do get an agreement, actually, because the president getting the virus again puts it back on the front page, at the very top of the front page. And I think it will have an effect. You're already seeing stories again over the weekend with places like New York City talking about closing schools, for example, again in certain areas of the city. these sort of rolling partial lockdowns that are happening both in the United States and over here in the UK and in Europe suggests that, you know, we're going to be dealing with this on an ongoing basis in coming months, and that certainly seems to be what governments are planning for. So I do think that raises the possibility that actually a fiscal stimulus might be more likely, in the sense that getting something done ahead of the election was probably not a bad policy, given that there is, I think, possibility that some of the economic data does start to just to reflect on the fact that people are probably going to continue to be socially distancing and to be being careful. And I think the president getting the virus is a possibility, therefore, a positive for trying to get a fiscal stimulus done, which would have to be done pretty much this week if they're going to do it.
All right, Bill, thanks very much for joining us. We have more questions for you, so we're going to keep you around one more block. Bill Dinning, Waverton Investment Management CIO, stays with us here on the European Open. Coming up, with only 2 weeks before the UK Prime Minister's deadline to reach a deal, a period of intense Brexit negotiations begins today, with significant divides still to bridge. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open, 12 minutes into the session right now, and looking at 1% gains and more on European equity indexes. Here you can see banks up 1 1/3% and industrial goods up more than 1% as well. Let's get the Bloomberg Business Flash. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Cineworld is temporarily closing all its movie theatres in the US and the UK, hitting about 45,000 jobs. The move comes after MGM cancelled the November release of the new James Bond movie, pulling the plug on one of the few big films left on the 2020 calendar. Cineworld is set to warn that delays of blockbuster releases are making the industry unviable. Italy's Nexi has agreed to buy SIA in an all-share deal to create one of Europe's biggest payment providers. The combined company will have an annual revenue of about 1.8 billion euros and a market value of more than 15 billion euros. The deal has taken more than a year to complete. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thank you very much. Laura Wright in London with your Business Flash. Now, a 2-week period of intense Brexit negotiations begins today. This follows a call on Saturday between Boris Johnson and European Commission President Ursula von der Leyen, in which both renewed their commitment to getting a deal. Major compromises on the key disagreements of fishing rights and state aid are still needed. Bill Dinning, Waverton Investment Management CIO, is still with us. And Bill, I think that UK assets feature in your thinking quite highly at the moment. How do you draw a distinction between the very short term and the volatility perhaps that we expect to see in UK assets around the Brexit headlines and the individual businesses in the UK that you want to invest in?
Well, certainly the sort of macro issues around UK politics, around Brexit, etc., have been one of the factors that I think has sort of depressed certainly international investor interest in the UK, and that probably has had a slightly depressing impact. But the UK market has got a lot of bad news priced into it. Now, there are issues around the structure of the UK market and the sort of companies that have historically dominated the market here being, in many cases, particularly the energy companies or the banks, materials companies, not the sort of places that investors want to be in at the moment. But one of our feelings is that the UK market, as I said, has got a lot of bad news in the price. The underperformance of the UK in the last 2 or 3 years has been pretty excessive. And there are some world-class businesses here. There's a couple of very good pharma companies. There are interesting companies in other sectors. So we think the UK is certainly on our radar. But obviously what happens with Brexit is going to be important, because if we can't get a deal with the European Union, we'll probably have another wave of selling of UK assets, including, of course, of sterling.
We're seeing, by the way, Spain services PMI missing by a long shot. The reading in Spain for the services PMI in September, 42.4. The forecast was for 46.4. The composite PMI falling to 44.3. The forecast for 47.7. So just to give our viewers a couple of headlines from the Spanish economy there. But Bill, you're talking about the UK economy. You're talking about Brexit. And I know you like some stocks in the UK. Shell, I believe, is one. Ocado is another. Do you like stocks that you think will not be at all affected by Brexit, or are they just so undervalued?
Well, I think the first thing that's sort of drawn our attention to the UK is certainly the aggregate valuation of the market. It's very dangerous to compare, as we all know, to compare simple valuation measures across borders. But 4 years ago, the UK had the second highest price-earnings ratio of any of the major markets. Today, it's got a lower price-earnings ratio than any of them. And then if you then look at the individual companies, then obviously a company like Shell, has been a sort of poster child for everything that investors have been wanting to avoid. There have also been some individual decisions made by the company that haven't been appealing to investors. But, this is a world-class company, and I think that should there be a change in tone in terms of what investors want out of their portfolio, then I think Shell's well positioned for that. And as you say, Ocado, there's obviously been some news flow about that in recent days, but nevertheless, this is, again, to our mind, a sort of world-class business that we continue to think will grow well. So, yes, we think there are some opportunities in the UK, and I think that increasingly, I think investors may start to look at that, particularly if there's any sort of broader rotation in the market, because there's, to be oversimplifying it a bit, the UK is seen as a value play, and that's obviously, again, not been where people have wanted to be.
Bill, thanks very much. Thanks for joining us. Bill Dinning of Waverton Investment Management, where he's CIO. Bill will be joining us in conversation on Bloomberg Radio at the top of the next hour, 9 a.m. UK time. Matt was just breaking the services PMI numbers out of Spain. In the corporate sector, in the banking sector in Spain, also some really interesting stories breaking right now. Unicaja has confirmed it's in preliminary contacts with Liberbank on a merger, and this after we carried a story over the weekend that suggested that these two banking institutions institutions were talking, and we know, of course, that consolidation within the Spanish banking sector has been a theme for some time. A deal to combine these two lenders would create the country's 7th biggest bank. They actually failed to get this kind of deal through last year after 5 months of talks, partly due to differences over the shareholding structure. So we'll see whether the pressures of COVID-19 and a global pandemic can push things through this time around. Coming up on the program, global COVID infections surpass 35 million as cities impose further restrictions. We get an update next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are 21 minutes into the session right now, and we're looking at big gains across European equity indexes. You can see the stock 600 right now up 0.7%, but it's some of the industry groups that are making the headway here. Autos, for example, up 1.7% right now. You can see bank stocks up 1.8% as a part of the broader stock 600 index there. Now, let's get over to Danny Berger right now because she's got the story on the possible expansion of the German DAX index. Danny?
Matt, yeah, that's just one part of it. There are really two buckets that the owner of the DAX has proposed. One of them are qualification requirements. The other one, the index composition itself, which is the DAX moving to 10 more members to 40, and the MDAX, the mid-cap company, going down to 50 from 60. The qualification proposals, I think, are really fascinating because it's hard to really see this other than a response to Wirecard. One of the big changes they said they'd make is the introduction of a new independent audit committee, and this committee would look at the accounting processes for companies as well as their risk controls. And if the companies are non-compliant, they say they will have a fast exit from the index. They've also said there are going to be new profitability requirements as well as liquidity. And let's remember when the Wirecard accusations of fraud occurred, it took about 2 months after the collapse of Wirecard, but before it was eventually pulled from the DAX. Now, another requirement that they're introducing as a proposal is a ban on any companies involved in controversial weapons. It's really unclear as to what companies that will be. They say that there's one company in the MDAX that would be excluded if they do introduce this screening. But there are a lot of companies involved in the manufacturing of defensive systems, as we've been discussing, Matt. Everyone from Rheinmetall to Airbus. So we're not totally sure on who that will be yet. And these proposals, they'll be decided over the coming months. Matt, Anna?
Danny, thanks very much. Danny Berger with the latest on plans afoot, perhaps, at the DAX. Now, global COVID infections surpassed 35 million as the focus remains on the health of the US president. New York City is closing businesses and schools in 9 hotspots. On this side of the Atlantic, AFP is reporting that Paris will shut down bars for 15 days. And the UK Prime Minister Boris Johnson is warning Britons of a tough winter ahead. Joining us now is Bloomberg Intelligence's Director of Research, Sam Fazeli. And we've talked to you many times about the spread of this virus, Sam, so it's very good to have you back on with us. UK officials then confirming that thousands of positive cases had been missed from COVID test results during September. What's the significance of this? I'm remembering that the Chief Scientific Officer, of course, cautioned comparing these kind of infection figures we're now seeing in September with March, saying maybe in March we were actually seeing 100,000 a day. We just didn't have the capacity to test to see that. So the different testing regimes clearly important. I guess what really matters is whether we see the hospitalizations to reflect the infection rates.
Yes, absolutely, Anna. And I have to say that, you know, I've got access to some data that one of our providers sends us, and that really does show that even in the U.S. you've got the same thing. The number of people actually going to hospital for treatment as inpatient is much lower now, almost half. I think it's a lot of that has to do with the fact that a lot of other physicians in other settings, emergency rooms, even general practitioners, have become much more savvy about how to deal with this infection and not panic and send everybody to the hospital. So there's some of that going on. And of course, you've got the demographic change in terms of a lot more younger people are getting it, so they're less likely to get sick. So a lot of that in there. And I completely agree with the chief scientist in terms of the testing. You know, I personally know 3 people that certainly had it, given the symptoms, but never went for a test because there was no such thing at the time.
Yeah, tests I find still here in Berlin are very difficult to get, even if you have symptoms. How difficult is this winter going to be then, with so many people increasingly getting the infection and testing positive, so many people getting it and not even getting tests?
That's interesting you say that, Matt, because in France, certainly where I live, and in the UK where I also live, the friends and family who've had a risk of having potentially caught it can get even without symptoms, can get a test really quickly and get a result. I mean, we've had even one result come back the same day. So, and that's the big test, the swab. So, but it's going to be a very tough winter because at the end of the day, we're all going to go inside more, which is where the virus infects better.
Absolutely. Sam, thanks so much. Sam Fazeli from Bloomberg Intelligence. Welcome back to the European Open. We are 30 minutes into the trading day, and we're looking at equity indexes that are up across European, the European equity indexes are up, the UK equity index is up, and here you can see the broader stock 600 index gaining right now about 0.5%. What's more interesting is to take a look under the hood and see which industry groups are leading the charge here. And if you do that using the GRR function, group ranked returns, you can see that auto and auto parts makers are doing quite well, telecoms, as well as banks and retailers are up today. Now, it's been a weekend of speculation about President Trump's health. White House physician Sean Conley now admitting to giving a misleading statement about the president receiving oxygen. In a video on Twitter, the president said he's learned a lot about COVID-19 over the past few days.
It's been a very interesting journey. I learned a lot about COVID. I learned it by really going to school. This is the real school. This isn't the let's read the book school. And I get it, and I understand it, and it's a very interesting thing, and I'm going to be letting you know about it.
Now for more, let's go to Bloomberg's Kaylee Lyons. She joins us out of New York. Kaylee, what do we know now about the president's condition? We have one doctor who's telling us conflicting things, but there are other doctors, very serious experts from Johns Hopkins, who are saying he is doing better and may go home today.
Yeah, we'll have to wait and see, Matt, if the president is indeed discharged to the White House as soon as later today. Many of his doctors, yes, sounding that upbeat tone, saying that he is improving, and many that may be due to the treatments that he's gotten. He's gotten 3 of them that we know of: an experimental antibody treatment from Regeneron, Gilead's remdesivir, and also dexamethasone, which is a steroid usually used in more severe cases of the virus. So that would indicate maybe the president's illness is progressing quicker than expected. That is part of that inconsistency we're getting from his medical team at the moment. And of course, there also remains questions about the timeline. On Sunday, there were reports that the president didn't disclose his first positive rapid COVID test on Thursday, instead waiting for the results from a second test. So there are a lot of still question marks around the president's condition, the timeline, and what, frankly, is going to happen next.
Kaylee, thanks very much. We'll wait for updates then. Kaylee Lyons joining us there from New York. Time now for the Brussels edition. Today we discuss the EU's recovery fund. Maria Tadeo has more. Maria.
That's right, Anna. And today, look, we're looking at the European Central Bank. As you know, there's a lot of speculation already in this market. If you look at the inflation print, if you look at some of the downside risks as to whether or not we could see the ECB take preemptive action maybe by the end of the year. And to talk about this, we're joined by Victor Costancio, who is with us from Lisbon. And Mr. Costancio, before we head into what the ECB may or may not do, I want to ask you a question about the language, because there's investors who would tell you at this point it's very difficult to read what the European Central Bank is doing. It's difficult to read what Christine Lagarde wants to get to. Do you think there's a messaging problem going on?
No, I don't think so. I think that the message has been clear. The programs to reflect the expansionary nature of monetary policy are in place and working. And you can see the outcome when you look for the market interest rates or market yields of sovereign debt and other in the credit market also. There has been a big decrease. You have now 10-year Greek bonds below 1%, as well as for Italy, for instance. So the expansionary nature is working, and is very clear. Also, the message that has been conveyed by officials of the ECB that they may change the program, increase if need be, and that's something good for the future. But it's working well so far.
And I just want to ask you again on the language. You know, when you hear Christine Lagarde, just to give you one example, you know, on the euro, where she says we're going to monitor it, but we're not going to target it. Let's not get too carried away. But then you do get the chief economist, Philip Lane, say, well, we look at this as problematic for the inflation outlook. Isn't that whiplash, though, for the markets?
Well, what Philip Lane said was that, of course, the ECB has to close monitor what happens to the exchange rate, but it has never been a target of policy, and it cannot be, and it isn't. And by the way, the fears or the noise in the market when the euro was creeping up to 1.20 against the dollar have subsided completely, because now it's again at 1.17, which, by the way, was exactly the level of the exchange rate when the euro started in 1999.
And you're right to say that the conversation on the euro has really changed over the past few weeks, but the conversation now changing into whether or not we're going to see action taken by the ECB potentially in December. Do you factor that we're going to see an increase in the PEP program? If it's not the PEP, what do you think we're going to see come December?
Well, I think that any measures that may come or not will concentrate on purchases of securities, either the APP or PEP. It depends. If indeed it is warranted to increase the program, which they can do, of course, but that would be more related to inflation prospects and performance than with anything else, and certainly not the exchange rate, which is now at a level which is, I would say, normal when we compare to the old trajectory of the exchange rate against the dollar since the inception of the euro.
And how much do you worry about inflation or the lack of, especially when you look at core inflation? There's some voices out there who are bringing up the word deflation again. How worried are you?
Yeah, you are right to point to the core inflation, because that's the more concerning figure right now. It has become very, very low indeed. The headline inflation reflects, of course, several well-known facts.
Morning, ladies and gentlemen. I'm placing a order to sell short euro at 117.29. That's it. Order placed to sell short at 117.29.
The very low level of core inflation right now. But on the other hand, we all know that this is something that has to do with some commodity prices. It has to do with the decrease in VAT in Germany, which weighs a lot in the index, and other factors related to the virus crisis, which is very specific. All these factors are things that monetary policy cannot offset in the short term. So we need a bit more data to reach a conclusion about inflation prospects, which they can do then in the December meeting.
And if there's a reason for concern on the inflation, I want to ask you also about another potential reason for concern, which is a recovery fund. You know, if you look at the recovery fund, the idea that there is going to be money flowing from the Commission to countries, so it's really anchored yields, but there's a lot of talk already that that could be delayed. How problematic could that be if we do see a delay to the recovery fund?
Well, it is problematic because one of the risks for the recovery next year could be the insufficiency of fiscal policy.
Okay, I opened new position, short position on euro at 117.29.
Of the recovery fund would take time, first to get final approval, and second to prepare all the projects and plans at member country level that are necessary to draw on the facility. And the Commission has published 2 weeks ago its proposal, which goes to the Eurogroup now in what regards the details, the objectives, the template for the preparation of those plans, and as in that proposal define the objectives of the recovery facility in relation to cohesion and resilience of the euro area through investments and reforms, and links the plans that have to be prepared in each country to the objectives of the medium-term initiatives of the EU, to the so-called European flagships, which are very much related with climate change and digitalization, concentrating more than 50% of the expenditure that can be done using those funds into these two areas, so making the program a medium-term support to more structural policies, which is a guarantee that the money will be well spent, being compatible with medium-term objectives, but also linking the plans to the European semester and to the country-specific recommendations. So the proposal of the Commission is surprisingly quite detailed and complex, mentioning perhaps too many objectives at the same time, because there are 4 major objectives, as they say. So that implies that, for instance, the ECB in its monthly economic bulletin has foreseen that in 21 only 10% of the grants program can be disbursed, and 15% in 2022, which means that the bulk would be concentrated only in 23 and 24. So this indeed means that the European level fiscal stimulus will not be very significant next year, which implies that national fiscal policy will have to continue to be expansionary, which, by the way, is foreseen in all projections of international organizations that are foreseeing a deficit at the euro area level around 8–9%, and next year
so we'll continue to go
5
up,
to 6%.
exactly.
Yes, so
Mr. Costanzo,
that puts that next year on national fiscal policy. As you know, nevertheless, the Stability Pact has been suspended also for next year, which helps. But I think that a deep revision of the Stability Pact is now totally needed and has to be on the table to discuss.
And should be put into practice.
I don't see that after. Yeah, I don't see that after this type of crisis and the increase in debt can be compatible with the present terms of the Stability Pact.
Well, Mr. Costanzo, thank you so much for joining us. We're always happy to speak to you. Of course, very detailed proposals there, but we have to see whether or not they can translate into the real economy. And that's it for another edition of the Brussels edition. Anna, Matt.
All right, Maria, thanks very much. Maria Tadeo there in our Brussels studio with Vitor Constanzo, former vice president of the ECB. Now, Weir Group shares jumped the most since 1999 after it announces the sale of its oil and gas business to Caterpillar. Up next, we'll speak to the CEO, John Stanton.
Welcome back to the European Market Open. We are 46 minutes into a European trading session that shows European equity markets up by 0.6% this hour. Now, Weir Group's sale of its oil and gas business to Caterpillar looks like a good outcome for the company. Its shares have jumped the most since 1999. Joining us now is John Stanton, the Weir Group CEO. John, very good to speak to you then. As you get ready next year to celebrate 150 years of Weir Group, I think, tell me just how transformational this is, how much of a significant break with the past this deal is for Weir Group.
Good morning, Anna. Yes, thank you. No, it's a major moment for us. Over the last 4 years, we've been undertaking a transformation from quite a diversified flow control business, working in lots of niches, to become a pure play business in the mining and minerals technology space. And this deal is the final step in that journey to create that future vision that we were working towards. We sold our flow control division a couple of years ago. We acquired ESCO, added that to our minerals division. So now we've got that focus in that space, and I think a bright future ahead. The Weir Group has sort of transformed itself many times over the years, and this is just the latest in a long line of those transformations. But we're very excited about the future that it creates for us.
When did you start these discussions, John? Is this a COVID deal?
No, we've been thinking about this for over 12 months now, and of course we announced that we were going to sell oil and gas back at the end of February, just as the whole COVID situation was developing. So, as I say, it's part of that journey that we have been on. The COVID situation obviously created some challenges in terms of executing the deal, but I think the team has done an amazing job to get us over the line in challenging circumstances. And as I said, it's it is clearly a tough time, but for us, it's about the value that this creates in the future by having that absolute focus going forward in a sector where we are incredibly strong, but for a number of reasons, we think the future is very bright, driven by population demographics, growing population, urbanization, carbon transition, which will require more copper and battery metals that we're exposed to. The vast majority of the world's copper is produced through our equipment, for example. And then a mining industry which has set out very challenging net zero targets and needs to transform and adopt new technologies to reduce its energy and water consumption. And we're ideally placed to help them go through that transition.
And so you've talked about some of the areas you're excited about, John. You've got some money to invest now, perhaps. Some analysts talking about where you're going to invest that now. Any suggestions as to where your priorities for investment will be?
Well, we do see ourselves as a consolidator, and that's what the M&A has always been part of the DNA of Weir, and that won't change going forward. But we have been a disciplined acquirer, and we'll continue to do that. When you look in the mining value chain, we now have a position where we're providing equipment into the mine itself on the extraction side through ESCO and its grind engaging tools. We have a crushing and grinding offering on the dry process side of a mine, and then our pumps and other valves and cyclones and so on, which operate in the wet part of the mine, and also on the tailings management side. So that's where we operate. We think that's the best part of the mine. It's where all the wear and tear takes place, which means that our equipment is exposed to highly abrasive type operations. It means it generates a lot of spare parts. And across that part of the value chain, we think there's opportunity for us to continue to consolidate in the future and build on the already strong portfolio of products and solutions that we have in that space. So over time we will look to add to our already strong offering.
All right, John, great to get some time with you today. I know a very busy one for you. Thanks so much for joining us. John Stanton there, the Weir Group CEO, after that company sold its oil and gas business to the world's largest producer of earth-moving equipment, Caterpillar. Up next, can stocks advance without more stimulus? That's our MLive question of the day. We'll talk about it with Eddie Vanderwalt next. This is Bloomberg.
welcome back to the European market open, 8:53 here in London, so 53 minutes into a broadly positive trading session as the markets digest the latest news flow around the health of the presidents of the United States and hope for fiscal stimulus. Let's get to our markets conversation now with Markets Live, Eddie van der Walt, who's with us. Eddie, good morning to you. You've been thinking about copper. We were just talking to a company that previously did a lot of business in oil and gas and is now pivoting more to mining, and copper is part of that story. What do you see structurally in the copper market?
Morning, Anna. I think we're going to see more and more of that. I think a lot of companies that see their business as producing oil, I think are going to look at copper because the long-term prospects for copper are extremely good. As we shift to green energy and as we shift to electric cars, we will be consuming more and more copper. And the bull case is that we've been looking for copper, humanity's been looking for copper for a long, long time, since Roman times. We've identified all of the major resources. So that makes a very strong long-term bull case. But in the short term, it's a very different picture because in the short term, there's still all this worry about global growth and about consumption and manufacturing and all of that. And copper just cannot disconnect from its near-term fundamentals for a very long time. So over the last 2 weeks, we've seen that. We've seen copper come back about 4% in 2 weeks. And I think that correction was on the card. But the long-term bull case remains intact.
Eddie, what have the Romans ever done for us? No, that's not a serious
question. How much time have we got this morning?
No. Listen. I want to get to the question of the day on the MLive blog. Can stocks advance without more stimulus? I think that's going to be a key focus this week.
Yeah, which stocks though? Which stocks? I think stocks do need stimulus, and I think the case for stimulus is a little bit harder with Trump in hospital and the wider outbreak that we're seeing in Washington. People, may just be a little bit more nervous about shaking hands on a deal. But I think stocks do need it, but I do think at the same time, your FANGs have been acting as a sort of a haven trade. Whether that continues, it's very hard to say. But I think for the wider market definitely needs stimulus.
All right, Eddie, thanks so much for joining us. Eddie van der Walt there from the MLive blog. You can check out his work and the work of his colleagues by typing MLIV Go on your Bloomberg terminal. We do see German September services PMIs coming out a little bit better than anticipated, or a little bit better than the preliminary reading, going kind of against what we saw in Spain. The services PMI in Germany, 50.6. The preliminary reading was 49.1. That's it for the European Open. Stay with Bloomberg Television. Surveillance is up next. This is Bloomberg.
President Trump might be released from hospital as soon as today, despite conflicting reports from doctors on his treatment and health. Markets recover from Friday's risk-off turn. Last call, France reportedly plans to shut down bars in the Paris region as part of new coronavirus measures to be announced today. And Cineworld shuts its doors. The world's second-largest cinema chain temporarily suspends operations with no new film releases on the horizon. 45,000 jobs are at risk. Shares slump. Well, welcome to Bloomberg Surveillance, everyone. I'm Francine Lacqua here in London. This is what the markets are doing now, pretty much as steady as they go. For the moment, at least, they seem to be range-bound. A lot of the focus is on President Trump and, of course, his health. A lot of the focus is on some of the risk-off mood that we saw on Friday, not filtering through today. Although I'm looking at yen, it is retreating. Treasury is pretty much steady. And then the pound weakening as negotiators started a two-week period of intense Brexit talks. Now let's get straight to our top story. It's definitely been a weekend of speculation over President Trump's health. Now, White House physician Sean Conley now admitting to giving a misleading statement about the president actually receiving oxygen. Well, for more, let's go straight to Bloomberg's Kaylee Lines, who joins us from New York. Kaylee, what do we actually know about the president's condition right now?
Well, doctors in a press conference on Sunday sounded fairly upbeat, saying that he was improving and could be discharged as soon as later today. But their remarks were a bit inconsistent. They left some holes. They withheld information about his lungs and notably his oxygen levels. As you alluded to, Francine, White House physician Sean Conley telling reporters the president did indeed receive supplemental oxygen on Friday. Conley had previously said that he did not. Now, we also know the president has been given 3 treatments, an experimental antibody treatment from Regeneron, Gilead's remdesivir, which is an antiviral drug, and then also dexamethasone, which is a steroid, and it's usually used in later stages of the virus in more severe patients. So doctors outside the president's own medical team say that could mean the illness is actually progressing quicker than expected, or he contracted it a lot earlier than previously thought. So there are still some question marks around the timeline around the president's condition, and we're going to have to wait and see if he is indeed discharged later today, Francine.
Kylie, the president took a surprise drive by supporters outside of Walter Reed Hospital. What has the reaction to that been?
He has taken a little bit of heat for it, some in the medical community saying that drive-by, doing so, he was endangering his staff and some of his Secret Service agents. Now, the Secret Service said safety protocols were followed, but to some it plays into this longer narrative of the president not taking the virus seriously enough and not acknowledging its risk. Now, it's likely what the president was really just trying to do was get his face out there, show the American public, and most importantly, his supporters, that he's doing well and is okay, especially considering he is off the campaign trail for the foreseeable future, Francine.
Kaylee, what's the impact on the polls and the election?
We're starting to get those numbers trickling out. Polling showing the president has fallen farther behind in the race against Joe Biden since last week. An NBC Wall Street Journal poll taken just after the presidential debate, but before Trump's positive COVID diagnosis, shows Biden leading Trump by 14 points. That is the biggest lead of the campaign. But again, that poll was taken before the president's diagnosis. There was also an online survey conducted by Reuters Ipsos over the weekend, taken afterward, and it showed 9 out of 10 Democrats and half of Republicans said Trump could have avoided getting sick and that he isn't getting any kind of sympathy boost. So if you take a look at the Real Clear Politics betting odds on who will win the presidency, the probability of Joe Biden winning is up to 61%, Francine.
Thank you so much. Our Kaylee Lines there in New York with the very latest on President Trump. Now let's get to Suda David Wilp, a deputy director of the Berlin office at the German Marshals Fund of the United States. Suda, thank you so much for joining Bloomberg Surveillance this morning. Wow, it's been quite a weekend. It was very difficult to ascertain the exact health of the President of the United States. I mean, do you feel like we now have a White House that's a bit more transparent? Do we actually know how sick or how not sick the President is?
Good morning, Francine. Yeah, I mean, this is sort of the storyline of the Trump presidency. You know, what does one believe? This White House is known to put out misinformation. In fact, Cornell University put out a study last week saying that President Trump is a large source of disinformation during this pandemic. It's hard to say. I mean, we've seen videos of the president, but we've also received conflicting reports between Chief of Staff Mark Meadows and what the doctors at Walter Reed are saying. So we don't really know. I think it has it's quite brave and ambitious of the doctors to say that he could probably return to the White House Monday. So we'll see how the day proceeds.
So how will this play out in the election? Will, President Trump get sympathy, or actually is this completely against him?
Well, as Kaylee mentioned, I think the voters in America may have sympathy for him, but at the same time, I think they see that he sort of flouted the public health guidelines of his own administration, disdaining the use of masks, not paying attention to social distancing, and holding large rallies and events. I mean, this whole thing started with the so-called super spreader event in the White House lawn for the event with Supreme Court nominee Amy Coney Barrett. So, I mean, I think people are also kind of fed up, and the polls show that the majority of Americans think that this is something that could have been avoided. And I should also say that, this is also breaking down trust in America. Distrust in institutions and government was already low even before Trump entered office, but now you see distrust both on the left and the right, with people on the left not even believing that President Trump may have contracted COVID. I mean, this shows sort of the state that we're in the United States.
Sudha, I mean, apart from, does it make a difference actually if the president gets released today from hospital or not? And apart from that, is it all about the vice president's debate this week?
Well, certainly all eyes will be on this debate this week between the vice presidents. Usually, the vice president pick doesn't have a huge impact on the race. Certainly, you could pick a running mate that would give you a state like Indiana with Vice President Pence with the conservative evangelical voters, or Kamala Harris, a woman of color that may bring out Black women to vote for Vice President Biden. But at the end of the day, this is now about, will these two candidates, whoever is voted in November, will they actually be able to complete a term in office? And this is why people will watch who the vice presidents are, because they could very well step into office before 2024.
Sudha, very quickly, do you trust, I mean, if you look at the polls, do you trust the polls in the U.S., or is there still such a big margin of error that actually everything's to play for?
Well, my hope is that pollsters have learned from 2016. I think people don't make bets anytime now after 2016 on the way the election is going to go. And there's also this phenomenon of the shy Trump voter that one hears about that may not necessarily divulge that he or she is going to vote for President Trump. But right now, all the polls seem to be pointing toward a win for Vice President Biden. And also in those crucial swing states, we saw a poll that said that Biden is also ahead in Florida and Pennsylvania. And, even the state of Ohio, which people like former Speaker Boehner, who I hosted in Berlin last fall, thought that Ohio is firmly red. I think that the Biden campaign is actually looking at Ohio to keep it in play.
Thank you so much, Sudha. David Wolpe there, Deputy Director of the Berlin office at the German Marshall Funds of the United States. Now, coming up later today, we'll speak to Charles Evans, the Chicago Fed president. We'll ask him about treasuries. We'll ask him, of course, about inflation and debt. This is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Happy Monday, everyone. Now let's get straight to the Bloomberg. First word news, here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Here, Prime Minister Boris Johnson is warning the UK faces a very tough winter ahead. Speaking to the BBC's Andrew Marr, he said he accepts the public is angry with his handling of the pandemic. He also admitted that his government's summer plan to subsidise dining, Eat Out to Help Out, may have helped spread coronavirus. Now, over in the US, wildfires in California have burned a record 4 million acres so far this year. That's a bigger area than the state of Connecticut. It's more than during the previous 3 years combined, and it's more than double the previous record set in 2018. The results are devastating. Fires have killed 31 people and destroyed more than 8,400 buildings. And Dow Jones is reporting that President Donald Trump didn't disclose his first positive coronavirus test. It says he took a rapid test on Thursday, but waited for the results from a more thorough COVID screening before actually telling the public. It says he knew of the first positive test before his appearance on Fox News that evening. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now let's get back to the markets. With us this morning is Andrew Sheets. He's Chief Cross-Asset Strategist at Morgan Stanley. Andrew, thank you so much, as always, for joining us on Bloomberg Surveillance. There's a million questions about the president's health and how that will play out into the election and how that actually that plays onto the markets. What are you looking at?
Well, I think there are kind of a couple of things to keep in mind. I think the first is that when we think about this in the context of, will it affect the results? Will this be a major change in the campaign? I think so far this election has actually been very remarkable in that the polling has been extremely stable, and it's been that way for a long period of time. So, in some ways, I think by a lot of measures, this is kind of the most stable presidential race that the U.S. has seen in a number of election cycles. So, in terms of the ability of any event, even as one as serious as this one, to kind of really change the direction, I think that's somewhat minimized, and I think that could also help explain why the market reaction so far has been relatively muted, because I do think the market understands that this has been a relatively stable race and may continue to be that way.
So, Andrew, what does it mean for, the bet on who wins, and what does it mean for what kind of exposure you want to certain asset classes?
Well, I think what is, most interesting here is I do think the different outcomes could drive very different styles of what would work in a portfolio. I do think that, under a Biden administration, especially one where you saw Democrats also take control of the Senate, I think the market's focus would immediately shift to a much larger, more aggressive fiscal stimulus plan. And I think that would, potentially drive yields up more, drive the yield curve steeper, and drive better performance from smaller, more early cycle, more cyclical stocks and financials, things that benefit from that type of price action. And I think what was actually somewhat interesting is if you look at the price action on Friday, even though the overall market was down, you did see some indications that the market was actually trading in a slightly more economically optimistic type of way. So the bottom line, I think, I don't think the question of who wins is the determining factor of whether or not the stock market will be higher in a year's time. I think under either candidate winning, we could see that. But I think it could drive very different implications for kind of what would lead that market and what kind of that mix of market performance would look like.
What do you worry about for the Fed, Andrew? Is there a sudden, bout of inflation coming?
Well, I think for the moment, the challenge the Fed has is I think they've kind of done their piece. They've they've eased aggressively. They've done more easing than they ever had, and I think they are now. They're not out of tools, but I think that we don't expect them to cut rates negative. They're already doing a very large and aggressive QE program. I do think that the issue with the Fed is that I think the focus has now shifted to fiscal stimulus. That's going to be the real driver for the market, and that's actually quite a remarkable thing, because we've been living, as you know, for the last decade in an environment where monetary policy has always been the most important thing. But I think that's shifting. I think we're shifting to an environment where fiscal policy is now the more important thing. And I think we even see that a little bit in the day-to-day news flow, where the market's more focused on what Speaker Pelosi and Secretary Mnuchin are talking about than maybe what the next Fed speaker is going to say. So I do think that the Fed has been very aggressive. I think that support's been right, but I think now the real kind of direction of the market is more likely to be driven by fiscal policy than monetary policy.
Andrew, will we get some kind of stimulus package in the U.S.? And does the Trump illness make it more or less likely?
Yeah, it's a really difficult question. Our base case is still that a deal won't get done before the election. One is we have a limited amount of time. Two is, while it is encouraging that Speaker Pelosi and Secretary Mnuchin have been speaking, and it does appear that the Trump administration would like to do a deal, I think somewhat ignored in all of this is that the Senate and Majority Leader McConnell have never seemed all that warm to the type of deal that's been talked about, and McConnell's been very clear that he doesn't want to bring a bill to the floor unless he can get a majority of his members on board with it, and there are challenges with that. So, I still think that all of that is, in the view of our public policy team at Morgan Stanley, kind of signs that the odds are below 50% for a new stimulus deal. But after the election, that very well could change. And again, I think that will be kind of the main focus. It could be a reason why actually a scenario of divided power could maybe be worse for the market, in the sense that it makes post-election stimulus harder than non-divided power.
Thank you so much. Andrew Sheets there from Morgan Stanley stays with us. Now, coming up, global COVID infections surpassed 35 million as cities impose further restrictions. We discuss the lockdowns and restrictions next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, happy Monday. It's going to be a busy week, and of course, we're looking at the number of infections. Let's get back to the pandemic. And global COVID infections surpassed 35 million. New York City is closing businesses and schools in 9 hotspots. On this side of the Atlantic, AFP is also reporting that Paris will shut down bars for 15 days. And here in the UK, the Prime Minister Boris Johnson is also warning Britain of a tough winter ahead. Now, still with us, Andrew Sheets from Morgan Stanley. Andrew, when you look at some of the restrictions or the possible lockdowns, does it really make a difference for what asset classes or what countries you want to be invested in?
Yeah, so I actually think that here it's important to keep something in mind that what I think the market probably prefers longer term is maybe at the risk of saying the obvious, better control of the virus. And so more lockdowns can be fine, maybe can even be preferable, if they result in a better long-term outcome. And so, right, I think it's quite clear that if you don't lock down sufficiently, it's a little bit of a kind of a false sense of security. It doesn't fix the problem, and the market can see through that. So, moving to more restrictions, I don't think the market would that's not the real problem. I think the market would actually probably be more concerned if it felt like sufficient measures weren't being taken potentially to prevent a longer second wave. So, for markets, we think all of this continues to drive a pretty choppy period of, kind of ahead of the election. You have COVID uncertainty, you have election uncertainty. But I think, as we look towards the end of the year and into next year, I think that uncertainty should ultimately recede.
So, Andrew, where do you want to put your money right now? What's your best play?
Yeah, so I think there are a couple of things that we like. We do like being short U.S. interest rates. We think that the risk reward for that, for being short duration is quite good. That again, I think you're looking forward to a reduction in uncertainty going forward, right? By December we should know more about the progress of the vaccine. We should know more about who's the next president of the United States. I think there are multiple political scenarios that could drive more fiscal stimulus, and long-term U.S. rates are still near their all-time lows. So I think those are already discounting quite a bit of bad news on the COVID front or the market uncertainty front. So that's something that we like quite a bit. We also do think that fundamentally, you will see a more kind of pro-cyclical early cycle rotation in markets. That's kind of paused over the last couple of months, but it's still in place since the lows in March, and we think that will still continue. So small caps outperforming large caps, cyclicals outperforming defensives. We still think that that's ultimately the right way to position. And we do think that again, as you look forward into next year, you will probably most likely move back to a period where the dollar is weakening modestly. Again, I think as a function of some of that uncertainty declining.
Is there anything, Andrew, that you liked in the fixed income space?
Yeah, so I think within all of this, we continue to see the best risk reward within corporate credit. It's not the most exciting asset class, but I think that in some ways in the near term that's the point, that we do think corporate credit is a little bit removed from some of these uncertainties around who will the next president be or how bad will COVID be. Just simply because I think credit will be more impacted by the more binary question of will the recovery continue or not. It's also benefiting from direct central bank support, and we think corporate bond supply, which has been historically heavy in the aftermath of this crisis, that will slow down as companies have now borrowed the amount of money that they need to borrow. So in terms of kind of waiting for some of this uncertainty to clear, we think kind of owning corporate credit and seeing that as kind of a relatively lower risk, slightly more boring way to take exposure is actually pretty good here is through the end of the year, and then then it might be a good time to reevaluate, but not until then.
Andrew, thank you so much. Andrew Sheets, Chief Cross Asset Strategist at Morgan Stanley. Now, we'll have plenty coming up. We also talk about Brexit and, of course, a political risk out there when it comes to foreign policy. Also coming up, confusing and contradictory. It's been a weekend of speculation over President Trump's health. We'll have all of the details, and then we talk about some of the markets that maybe that have been a bit unloved. We focus on emerging markets. We focus, for example, on Argentina. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, it's been certainly a weekend of speculation over President Trump's health, with his doctor admitting to giving a misleading statement about the president receiving oxygen. But his inner circle continues to strike an upbeat tone.
It's been a very interesting journey. I learned a lot about COVID. I learned it by really going to school. This is the real school.
We need to have trust. We need to trust that what they're telling us about the president's condition is real. We have to have confidence in the judgment of the doctors who are treating him.
Look, he's doing very well, and just like it could happen to anybody, but we're prepared. Look, we have a great vice president. We have a government that is steady.
His spirits were great. He was in a great mood. He was as direct and candid with me as he always is, and it was a great conversation.
Well, joining us now for the latest is our senior writer, Stephanie Baker, of course, has been following the Trump administration from the very beginning. Stephanie, apart from the fact that we learned that, the briefings were chaotic, what did we actually learn about the president's health over the weekend?
Well, I thought the briefing by his doctors yesterday was particularly revealing while confusing at the same time. The doctors finally admitted that he had received oxygen and that they had started a course of a third therapy called dexamethasone, which is normally only given to COVID patients who have severe disease and are having trouble breathing. So the picture was quite muddied. They were saying on the one hand that he was doing quite well, but that they had started this third therapy, which indicates, from what doctors say, that his inflammatory markers had risen and that that's usually only given to people who have difficulty breathing. But they danced around the whole issue of, where are his blood oxygen levels now, and has he received oxygen today? So, it continues to be a very confused picture, and, we'll have to wait to see what they say today.
Stephanie, how is this impacting the presidential race? Has it moved the polls, or do we just not have up-to-date polls yet?
Well, there was a series of polls that came out over the weekend, which were mostly taken in the wake of the debate, and only, included part of the time after we had heard that he had COVID, and that those polls did indicate that the debate performance hurt him. How much his COVID diagnosis contributed to that is unclear, but he's trailing Biden in Pennsylvania and Florida, according to at least one poll. The Trump campaign senior aide, Jason Miller, was on the weekend shows saying that Trump would get back on the campaign trail soon, and he made this surprise drive-by to his supporters outside Walter Reed yesterday, which was again criticized as a reckless move because he was seen in a hermetically sealed SUV with his Secret Service aides, and even though they were wearing masks and PPE, it still, at least one Walter Reed doctor commented that it was, he posed an unnecessary risk to those agents by exposing them to COVID. So I think it does contribute to this picture of sort of chaos around Trump. Whether or not he tries to use this illness as a way of educating people, and he pivots and he starts talking about the dangers of the illness and what we should be doing, and uses it as an opportunity to educate the public. Let's see.
Stephanie, thanks so much. Our Stephanie Baker there with the very latest, of course, on what we've seen. Now let's get straight to the Bloomberg First Word News here in London. With me is Leanne Gerrans. Hi, Leanne.
Hi, Francine. The global number of confirmed coronavirus infections has topped 35 million. The daily number of UK cases soared yesterday after a reporting glitch. It saw 23,000 new cases on Sunday, twice as many as Saturday, but said the majority of those cases were previously unannounced cases from the week before. Now, AFP is reporting the French government plans to shut down bars in Paris and bring in other new restrictions. That's as the country struggles to contain a spike in new coronavirus cases. AFP reports the capital and its inner suburbs will be declared a maximum alert zone with restrictions to last 15 days. Meanwhile, New York City is shutting businesses and schools in parts of Brooklyn and Queens. That's in an effort to stem a rise in coronavirus infections. The school closures will start on Wednesday, initially for a period of 2 weeks. Indoor and outdoor dining will also be banned in those areas. On Sunday, New York reported its 6th consecutive day of more than 1,000 new cases. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Let's focus in on markets and investment now as we're in the fourth quarter of a volatile year. Joining us now is Alain Carrier, the head of international at the Canadian Pension Plan Investment Board. Now, the CPPIB manages over $329 billion in assets. Alain, thank you so much for joining us. I know what you do is much more longer-term investment, so you take a longer view, but I wonder whether the pandemic and COVID-19 has actually changed fundamentally some of the trends that you're seeing. And so does that change your long-term investments?
Morning, Francine, and thank you very much for having me on. And as I said, thanks for pronouncing my name properly. It's a rare event for me here. Look, I mean, this pandemic is obviously it's from the world of investment and frankly any forecasting into a bit of uncertainty. The good thing about the CPPIB or CPP investments, as we call it now, is we really are long-term investors. The shape of our liability curve and the fact that we have cash inflows coming into the fund means that we can take a very long-term perspective. So whilst the short-term clearly is unpredictable, we are so well diversified globally and across asset classes that we are sticking to that fully diversified portfolio approach. Now, the pandemic will have obviously accelerated some trends that we've seen in the market, will have shifted some of the risk profiles across businesses and industries, and we certainly are intending to take advantage of that. I mean, consumer behavior, as you've covered many times on your show, is obviously evolving. E-commerce transitions that was starting to happen has certainly been accelerated, and some of our recent investments are taking advantage of that trend. Healthcare, how healthcare is going to be delivered to consumers is also, in our view, something that's going to be affected long-term and somewhat accelerated in terms of the transition. Look at cities and infrastructure. There's no shortage of debate, even internally within CPP, as to what that will do to the role of the city, to office parks, and so on. And these are clearly in some segments, aspects that we're looking at. And then I'd say finally, global supply chains will be affected, whether there's decoupling or not with China. I think companies are certainly looking at how their supply chain will need to respond to long-term trends. And again, that's something that we're very focused on. Taking a long-term approach allows us to make a few bets, if I can use that word.
So, Alain, when you look at some of the ultra-low interest rates that look like they're here to stay for quite some time, how difficult is it to be in the search for yield? Like, do you have to take more risk even if you're longer term?
You do, and I can go back to when I joined CPPIB 12 years ago. I mean, so we have a static cost of capital. Our mandate is to ensure the long-term viability of the pension system. And that, honestly, when 15 years ago, that cost of capital was the same. Our hurdle rate is we need to earn 4% real on the assets we manage to ensure the long-term sustainability of the CPP. That was a lot easier 15 years ago. 12 years ago when I joined again, you didn't have to construct the same type of portfolio to comfortably beat that. That cost has not moved. However, to your point, interest rates have gone lower. Asset pricing has reflected that trend over the last 10 to 12 years. And I think now you have to face a world where interest rates are likely to be lower for longer, as you mentioned. We have shifted our portfolio composition to reflect that. Our portfolio has 80 to 85% equity risk embedded into it, structured in different ways. But that has forced us to be a lot more hands-on, a lot more active, and to take, frankly, a much more fully involved view in terms of how we manage our assets long-term. So there's no doubt that you could argue the risk profile of the portfolio has increased in order to meet that challenge, but we still feel it's well within our comfort zone.
And one of the things that you were saying is, for example, you like healthcare at the moment, you like some of the e-commerce platforms, but is it basically a trend that was already there? So what do you do with sustainability? Is it a trend that was there, but the pandemic accelerates the change? Or could there also be, new trends that emerge from the pandemic?
I think it's a bit of both. The trends were there. I think a number of funds and investors were already talking about ESG, for instance, and some of these changes. I think the pandemic has brought that into focus. It has accelerated, as I was saying, some of that transition, and probably has highlighted the urgency of transitioning maybe faster than people anticipated. And I think, frankly, if you assume that a lot of people will be working from home, that you'll be delivering goods differently, that people will be paying for goods differently, and are forced now to adopt these new methodologies and new channels, it certainly will have accelerated the trend. And on the other hand, you could argue that some of these things that were not trending before now become real potential trends, such as real estate, what happens to city centers, and how people actually do work and congregate in offices. And so you put that all together, and I think we are witnessing a change in the way people work and consume that will not only accelerate, but shift in different ways.
Alain, thanks so much. Alain Carrier there from the Canadian Pension Plan Investment Board stays with us, and we'll talk a bit more about emerging markets as well. Coming up later today, we also talk to Margrethe Vestager, the EU Commission Vice President. That's at 4 p.m. this afternoon. And this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Cineworld is temporarily closing all its movie theatres in the US and UK, hitting about 45,000 jobs. The move comes after MGM cancelled the November release of the new James Bond movie, pulling the plug on one of its few big films left on the 2020 calendar. Cineworld is set to warn that the delays of blockbuster releases are making the industry unviable. Now, Facebook is hitting back at US government efforts to crack down on the company. Dow Jones reports the social network is saying any efforts to break up the main site from its subsidiaries Instagram and WhatsApp is a complete non-starter. It's citing a paper prepared by the company's lawyers, which says the move would cost billions of dollars and harm consumers. And Italy's Nexi has agreed to buy SIA in an all-share deal to create one of Europe's biggest payment providers. The combined company will have an annual revenue of about 1.8 billion euros and a market value of more than 15 billion euros. The deal has taken more than a year to complete. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now let's go back to the markets, and still with us is Alain Carrier from the Canadian Pension Plan Investment Board. Alain, thank you so much for staying with us. We were talking a bit about some of these low yields and exactly what it meant for your investment strategy. How focused are you on emerging markets, and do dollar dynamics change that in the near future?
Thanks, Francine. We're very focused on emerging markets. As I said, we are very diversified across asset classes and across geographies. We've been public about the fact that we wanted emerging markets to represent up to a third of our portfolio between now and 2025. I think we're well on our way to achieving that. And for us, it's quite a focused strategy when it comes to emerging markets. We're talking about China, India, a few South Asian countries, and a few countries in South America. But they're critical in terms of spreading the risk, diversification, and also access to uncorrelated returns. And we think that as part of a well-constructed portfolio, again, it allows you to get more return per unit of risk across an entire portfolio, and something that we feel is prudent for a fund our size, but also with the growth profile that we have as a fund.
So, I mean, how do you choose the emerging markets where you want to be invested in?
So, given the scale of the fund, and given also when we look at it, the long-term perspective, the fund today is in Canadian dollars. It sounds more impressive. I think you quoted American dollars there, but we're about 450 billion Canadian today on a trajectory to $1 trillion and even probably $2 trillion down the road. So scale is critical. We are hands-on investors. We are mostly direct investors in all our asset classes. So we look for markets where we can achieve scale and make sense of the amount of effort and also, frankly, the focus that we need to apply to some of these markets. So that's why we typically will choose to be very active with offices, boots on the ground, and very hands-on management and partnerships in emerging markets that can allow us to achieve that scale. And that's why it's somewhat limited in terms of number of countries.
We talked a bit about supply chains. Will supply chains actually, change significantly because some of the trade wars that we've seen and the way current affairs are headed?
It's one of the big questions, and I referred to it earlier, decoupling. I know there's a lot of political talk around reshoring of a number of supply chain elements. I can't say that we have seen a lot of that happening, but definitely the political discourse is not positive. There is certainly a risk that you will end up with two poles of innovation and two very separate worlds in terms of supply chain. And it's something that we're prepared for. So we are actually trying to hedge our bets in that way and how we invest. We remain large investors in China, not to name it, and also in North America. And we are partnered with some of the best companies in the sector, but it definitely is a risk that we're quite focused on.
And I don't know, one of the things that we've been trying to figure out, I know you're much more longer term, but it's basically when is inflation back? Because that would change everything for interest rates. And of course, if the focus from investors is on debt, is that 2-3 years away? Could it come? Is it something that you're worrying about, basically? Or is it going to be, in the next 18 months, and so not really something that you'll change your positions on?
It will not force us to change our position in the short term, that's for sure. We're always worried about unexpected moves in inflation. I will tell you, I'm not an economist. We have a number of them in-house. It's not something that we expect in the short term.
When you look at the best asset classes across what you're doing, is there a difference with equities, or do you look at currencies? How do you break that down?
We invest in a number of different currencies, and we typically don't hedge our investments. Everything is we express our assets in Canadian dollars. There's a bit of a natural hedge going on there between Canadian dollars and a number of global currencies. Canadian dollars is commodities based. Typically will weaken in low economic output where commodities are weaker. Flatters or at least acts as an offset to some of our reports, and so we manage a global basket of currencies, which by and large actually makes it slightly more stable. So yes, we do in some cases, especially if you mentioned the U.S. dollar and the risk of decline in the U.S. dollar that's made the press quite a bit recently. This is something that would affect the portfolio significantly, but given the number of currencies and how well diversified we are as a portfolio, we can weather pretty significant swings in currencies.
Thank you so much for joining us today. Alain Carrier there, the head of international at the Canadian Pension Plan Investment Board. Now, coming up, possible changes are coming for Germany's benchmark index. We discuss new proposals from the owner of the DAX next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
The president has continued to improve. As with any illness, there are frequent ups and downs over the course, particularly when a patient is being so closely watched 24 hours a day.
Well, that was President Trump's physician, Dr. Sean Conley. More on the president's health throughout the day. Now, we're also getting some breaking news. The Nets said to draw takeover interest from Nexi Global Payments. Again, Nexi, part of this payment system, yesterday was going to buy SIA for a $5.3 billion deal to form this payment giant. So a lot going on in fintech. Now let's talk about the DAX and some movement there in that global benchmark with our Danny Berger. Hi, Danny.
Hi, Francine. That's right. The company that owns the DAX has proposed new changes that are going to be debated, and whether they come into effect or not will be decided in November. Now, the big thing here are changes about who and the types of requirements that the DAX will use to admit new members. And a lot of this, Francine, you'd have to imagine is partially a response to Wirecard. For example, some of the new proposals include a new committee that would look over their accounting and also look over their risk controls. So this audit committee would have to assess all of the quarterly reports that comes out of the committee. There are also new measures put in place to judge who gets admitted, things like profitability as well as liquidity. Recall, Francine, after the scandal at Wirecard and the company became insolvent, it took about 2 months for the DAX to actually remove the company from its index. So this perhaps could help to that. Now, some of the other interesting tidbits in here include a ban on companies that are involved in controversial weapons. We don't know yet who this would include. They say there's one company in the MDAX that would be taken out with this screening. It could be Airbus, for example. It could be Rheinmetall. There are a few German companies that are involved with weapons manufacturing. So that, at the moment, we're not sure who that would include. And finally, the big change here would be the DAX expanding, becoming 40 members instead of 30. The MDAX getting 10 additional members, 10 fewer members, becoming 50 instead of 60, Francine.
Thank you so much, our Danny Berger there with the very latest on the DAX. Now, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York, and then a little bit later we'll also have a conversation with the Chicago Fed president. He's Charles Evans. A conversation, of course, on treasuries, a conversation in general about what's going on in the markets. A couple of people actually watching the program also writing in saying there's a bit of a disconnect with what we're seeing on the markets and the VIX, so we'll explore that a bit further. This is Bloomberg. another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television. President Trump may be released from hospital as soon as today, despite conflicting reports from doctors on his treatment and his health. Markets recover from Friday's risk-off turn. Last call, France reportedly plans to shut down bars in the Paris region as part of new coronavirus measures to be announced today. And summit showdown, Brexit negotiators brace for 2 weeks of intense negotiations. Officials say French President Emmanuel Macron holds the key if the EU's position is to soften. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, we track the markets as always, but really we've had quite an incredible weekend where it was quite difficult to know exactly the state of health of the President of the United States. So there were many questions about that, but actually this morning, markets seem to be a bit calmer.
Well, it's a global pandemic, and we're seeing it globally. Yes, the focus on Washington and what the President will do today at the Walter Reed Hospital. It is presumed he may, and the emphasis, Francine, is the word may, exit. We will see, of course, huge election pressures upon the president. In uproar last night, boy, Francine, I can't convey coast to coast the uproar of his road trip taken in the evening here of a perfect East Coast autumn day. But I'd also focus on the rest of the world. And the news out of Paris, to me, Francine, is distressing with the is lockdown the right word? I don't know. But there's some strict things happening in Paris.
Yeah, Tom, let's call it restrictions, extra restrictions that could also happen here in London. You know, you've had parts of New York where we're also seeing, school closures and extra restrictions, but this will probably be something over the next couple of months that we'll have to watch out. And it's the first time that we're seeing some aggressive restrictions from certain government officials. Now let's get straight to the Bloomberg. First word news in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, there's confusion over how President Trump is being treated for the coronavirus. In public, his doctors remain upbeat. One says the president could be released today from the military hospital in Maryland, where he's been since Friday night. Still, another said the president has been given supplemental oxygen and he has received medication typically used in more severely ill patients. Meanwhile, the president unexpectedly left the hospital to greet supporters who had assembled. He waved to them from his motorcade in a bid to demonstrate strength. And Joe Biden leads President Trump by 14 percentage points in the new Wall Street Journal NBC News poll. Biden's 53-39 lead is his biggest of the campaign. Voters were polled after Tuesday's debate, but before the president was hospitalized for the coronavirus. And in the UK, Prime Minister Boris Johnson is warning the public that a, quote, very tough winter lies ahead. Johnson said he accepts that people are angry with the way he has handled the pandemic. He told the BBC that it's going to be a bumpy Christmas, and it may even be bumpy beyond that. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine and Tom.
All right, Ritika, thanks so much. A lift to the market, but the VIX really signals the tension that we've seen on Friday. Futures up 16, Dow futures up 149, but the VIX printing right now 29.38. It'll be interesting to see how that comes in this morning with a quiescence that's out there. In the bond market, yields lifting 30-year bond. Let's talk about that with a 10 basis point move over the last number of days. 1.52% in the 30-year bond. The real yield, negative 0.94 to start the week. I don't know, Francine. I'm looking sterling 129.61. That must be because Tottenham did so well this weekend.
Exactly. Now they're moving, you know, the currency, especially sterling, Tom, it only moves depending on what football matches do. On a serious note, it's of course, and you know that, Tom, but good to remind our global audience that it is about Brexit and it's going to be 2 weeks of intense negotiations. Now, overall, consumer companies and banks are leading this broad advance amongst European stocks. Equity in Asia, we're also up. I'm looking at crude oil rebounding from a 3-week low. And then, look, gold, dollar, in general, haven assets dip edging lower, so that's why I wanted to show you a couple of the market moves there that we were seeing. I'm looking down at my screen to see exactly what they're doing, but you could also see it on TV. Now, joining us to talk about the markets, to talk about the President Trump prognosis and what it means for assets is Kit Jukes. He's Societe Generale Chief FX Strategist. Kit, as always, thank you for joining us. How does the market take, you know, if President Trump gets released today, does it have much impact on markets anymore?
I think it does boost sentiment. Look, you can see that where we were seeing sort of high volatility, strong yen, weaker equities on Friday in a pretty big way. Everything's better this morning just because the prognosis is so much better. And I think if he does go back to the White House, you know, certainly sitting in London where Prime Minister Boris Johnson spent a long time in hospital getting better, and everyone got themselves very worried. You know, I think the market would then say, yes, now we can get back to the election. We can get back to, will there be a fiscal deal, and you know, back to normal. I mean, the only difficulty is that when we get back to that, we have got 4 weeks of election politics, uncertainty about fiscal policy, and a market that sees the Democrats a long way ahead in the polls, threatening clean sweeps of the election, and so, you know, quite a lot to focus on that. That certainly makes me think there's plenty of uncertainty ahead.
But give us a sense, Kit, of what you think the market is pricing in on, you know, ahead of the election.
I mean, the market must be pricing in, you know, the possibility of a Biden victory because that's what the polls say. I don't think it's pricing it in completely because we've learned for the last 4 and a bit years to distrust opinion polls. It's pricing in, I think, that we'll get more fiscal accommodation. And most of all, more than anything else, the market is pricing in the Fed having the markets back with extraordinarily accommodative monetary policy for as far as the eye can see. And that's the bedrock of why markets are where they are, is the Fed, not anything else that's going on. I don't think so. Where I think you can get uncertainty is that the potential switch from Republican to Democrat in terms of, you know, the nature of fiscal policy in particular. I don't think that's priced in at all yet over the longer term.
Kit, I thought your note this weekend was just extraordinary. You always are strong, but particularly with Arsenal doing what they're doing, I thought your note was focused and just really, really smart. And Kit, I love the idea of the reverse of Japanification. We're in a disinflationary tone now. J.P. Morgan wrote extensively this weekend on the service sector disinflation. How do we reflate?
We have to reflate fiscally. I think that's the most important piece about this, is that we're going to see a significant change. And if you like, we're going to have to go back to the post-war years, back to the 50s, when we did a lot of things in this country. We made the UK a better place for everyone. We, you know, with what we did on healthcare, with what we did on education, with what we did on trades unions. You know, we lost it in the 70s, but the first bit of that was all positive. We are going to do that again this time, and in the United States, you'll do that as well because you have the financial capacity to. That will reflate over time for sure. It's this short-term piece where we are now. Where we've gone from financial crisis to pandemic, which is monstrously deflationary, but that's the now.
Well, I mean, I get the idea that we clear the pandemic and we move on and all have to agree to a reflationary world. in what level of inflation do we begin to ebb towards a reflation panic? I mean, I can't gauge that based on any kind of history from the 60s to Volcker and then, you know, on to this massive disinflation. At what level do I begin to say, oh, that's reflation?
You start to pick it up when you start seeing wider wage growth, the kind of things we saw in the 50s and 60s, that the share of the pie that was going to the normal worker, everyday family was picking up, as opposed to the share of the pie that was going to the owners of the capital. That's what made the post-war period in Europe and the US so much better than the 19th century.
That's brilliant, absolutely brilliant, but does technology preclude that? Are we in a new era where technology and gains from technology blocks increasing or assumed reversing increasing labor share?
It has been blocking it. I don't know if what the adjustment is in terms of relative to here now. You know, technology is ultimately why the 19th century saw no increases in prices in the UK for 100 years. So wouldn't knock it. But once you empower, once you have governments that want to make sure that the revenue is shared out amongst society more, once that's the focus, governments have control of this, not central banks at that point, not the rest of us. You know, there's other things that they can do, but I think that that history would definitely say, you know, that in the end you get the inflation because of government intervention without a central bank that's standing in the way.
Kit, is becoming more like Japan a bad thing, as long as, you know, we can limit the number of people losing their jobs?
Okay, becoming more like Japan is a bad thing in Europe, which is where it's most relevant today, in the sense that what happens to monetary policy is that if you disconnect inflation expectations downwards, which they're really threatening to do in the Eurozone now, after last week's data, then real yields, since Tom was referencing them, they go up and they send your currency up and they squeeze you. And it's very hard to get out of it. That's why the emphasis is, I need government, not central banks, to solve that problem. I have optimism about what US governments can do. I have some in the UK. You know, I am still really nervous about whether Europe can grasp the fact that reflation needs government involvement, not more of the same from the European Central Bank. And the danger is that we get a very strong euro before they learn.
Kit, thank you so much. Kit Jukes, of course, stays with us, and we'll have plenty more from Kit Jukes throughout the day. Now, coming up, the Chicago Fed President, Charles Evans, that exclusive interview at 11:30 a.m. in New York. That's 4:30 p.m. in London. And this is Bloomberg.
what would you say are the leadership qualities that you brought to the table or that you most admire?
I don't always have to be the smartest person in the room. I know collectively what a team needs, and I love having really great debates.
Good morning, everyone. Bloomberg Surveillance, Francine Lacroix in London. I'm Tom Keene in New York. An eventful Monday here, 10 days to the next presidential debate. If it occurs, we'll have to see how that unfolds through the week. Also, off of the jobs report on Friday, maybe a quieter economic week, but lots to talk about. We have been talking with Kit Jukes of SocGen about the disinflationary trends out there and maybe a more 60,000-foot discussion about the path to reflation. Let's move from 60,000 feet to 60 miles an hour down the Alpha Road, Kit Jukes. How do I make money now? Forget about defensive, forget about the political mumbo-jumbo. How do I opportunistically place capital now to create alpha by the end of the year? Did I sound like an institutional guy there?
You did. I got told I was sitting on the fence by a client this morning already, so I'm feeling very nervous about this kind of thing. I think the difficulty is that in the 4 weeks to the election, this market could go every which way, could be very choppy as we try to digest it. But if I had to place a bet, I would be placing a bet that opinion polls aren't usually this wrong, and that the U.S. is refocusing away from equity-friendly, tech-friendly in particular, towards U.S. households. That we're going to come out of the election on the other side of it with a big current account deficit in the United States. And so I want to come out of this short the dollar, long the idea that the world is going to be healing, but it's still a long road.
Brilliant. Absolutely brilliant. I want you to address now, Mr. Jukes, you in the trenches of actually winning and losing on Wall Street, various calls of a massive dollar weakening. They're out there. They're usually from academics. They're usually at 60,000 feet. The dollar's going to go down 20%, 35%, whatever the statistic is. Is that tangible reading, or is it a waste of time?
I mean, the dollar is going to go down over the next few years, but the reality is it won't do it in a straight line. The market is positioned long euros, long yen, and so by definition, short dollars. It'll be a much, much, much easier trade when we get to global reflation and when capital's flowing to emerging market assets, and it's a straight line fall for the dollar the way it was in the last big emerging market rally. But we aren't there. So it's fine to say it'll be 20% lower in 5 years' time, but the first 6 months of that can be difficult. I will be much more confident of those trends once I get past the 3rd of November and I can take the right now biggest piece of uncertainty off the table.
Kit, when you look at Brexit, how do you trade pound right now? So we're looking at 2 weeks of pretty harsh negotiations, and we seem to have hope that they can reach a deal, but then, of course, everything's left to play.
And I think the thing to focus on within that is that if we get a deal, there is much more upside to sterling, strength of sterling, than there is downside, because in real terms, sterling is so close to its all-time lows. We are trading, and have been since the referendum, disaster priced into the level, and just shades of disaster. So if you got some miraculous piece of good news that I don't expect, you'd get a big move. Other than that, it just trades sort of schizophrenically, choppily. It's really unattractive to trade and probably ends up weaker because, frankly, I doubt we can get a meaningful deal, and we're going to have to face up to the reality that between a pandemic and a global financial crisis and Brexit, we have taken 3 hits to this economy in a decade.
But how will the economy of the UK actually change? At some point, we're talking about a Singapore-like model. Could that help the UK be, more investable?
Yeah, and something always does. When in real effective terms your currency is really weak, something comes along to make it better. I wouldn't have guessed in 1976, when we had the all-time low, and I was only 14, that we would be on the brink of a big move higher, because we'd fight the unions, we'd find oil, and the world would change. But something will come along. It's just I'm not 14 anymore, and I don't know if it'll come along in my lifetime, let alone in the next year. In fact, I'm sure it won't in the next year. So I think the danger is that we continue to trade the pound in a level of, weak against the euro without getting dramatically weaker. And what it does against the dollar is very much going to be a function of what the euro does against the dollar, and that's going to be a bigger mover.
Kit, when we say that EM will do better, what do you mean by that? Does that mean their yield comes down, their price of debt goes up? Does that mean it's singularly equity markets, or is it just currency strength? I mean, what's the general statement EM will do better mean?
EM doing better, actually, EM currencies correlate more with growth, more with global growth and with their own growth. EM doing better means capital flows to them, their standard of living goes up, they have growth, their currency strengthen, and if their central banks try to prevent their currency strengthening, rates go down and their equities have a good time. And when I say EM, I don't mean China, Korea, EM countries that aren't really EM that are going through this fine. I mean Brazil, South Africa, Russia, Turkey, and perhaps most closely of all to you in Mexico, in sense of money flows to those places and their assets perform. We have not got to that point yet because of the sensitivity to growth and because they have so few tools for fighting a pandemic in their country. But when we get to that, then money will flow out of the US looking for those opportunities, and we'll get a good, weaker dollar.
Well, we'll get a good weaker dollar. I mean, I'm not going to say it's going to be a bad weaker dollar, but these dynamics are interesting. What are your dynamics, just to sum up this good conversation, what are your dynamics for the next 90 days? I mean, out to the end of the year. Is it just hunker down?
So my dynamics for the next 90 days is I still think that we'll get more bad news than good news for emerging markets. We don't have enough growth. We've still got too many headwinds. I'm still going to get more trouble for those. I think I will have a stronger euro by the end of the year. I suspect I'll have a stronger yen and a weaker dollar against a handful of G10 currencies.
How can you be this gloomy where Arsenal's ahead of Liverpool in the standings? I mean, I just don't expect this.
Because we're right at the beginning of the season, and I've been taught from being disappointed quite a lot in the last 15 years that I should just hold in and say, we're very close to a big turning point.
That's very good.
90 days, look, we're building the foundations.
We're building the foundation. It sounds, Kit Jukes, like you should be a Boston Red Sox fan in America. Thank you so much. He is with SocGen, Societe Generale. Kit Jukes, their chief foreign exchange strategist, which barely describes his holistic view. His research note of this morning is outstanding. And just to say it on a Monday, we protect the copyright of all of our guests. Get Mr. Jukes' good work through Societe Generale. Without question, the bank interview of the day, Christian Saving from Deutsche Bank in the noon hour. This is Bloomberg. Good morning.
The scale of the climate crisis is just staggering, but you can't let that be an excuse for doing nothing. So to fight climate change, we can't be overwhelmed by the seeming impossibility of the task at hand.
Inclusive multilateralism is about bringing more voices to the table, resulting in more ideas, more solutions, and more climate action.
As a signatory to the Global Covenant of Mayors, Charlotte has joined thousands of cities and regions in a commitment to accelerate ambitious, measurable climate and energy initiatives.
Local communities across our nation are stepping up in unprecedented ways to respond to the ongoing challenges of our climate crisis.
We'll see what is the cost, what is the reliability, but without innovation, a lot of innovation, we won't be able to get there.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. A deal in Europe will create one of the continent's biggest payment providers. Nexi has agreed to buy fellow Italian company SIA in a $5.3 billion all-share takeover. It took more than a year of negotiating to reach the agreement. Japan's NEC has agreed to buy Swiss banking software firm Avaloq Group. The price, a little more than $2.2 billion. It's making a push into technology for the financial services industry. Avaloq offers cloud services to banks and wealth managers. China's largest chip maker says the U.S. is placing export restrictions on suppliers. According to the company known as SMIC, U.S. suppliers have been told they are subject to additional limits. It's in discussions with U.S. officials. And that's the latest Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. In the equity markets, you've got a lift to the markets today, up 19. Dow futures up 107. That puts the Dow level 27,736. Off of the close, 27,682. The VIX, I still don't have a good print, 29.29 on the VIX and very early trading. Dollar weakness this morning. Francine?
Yeah, I'm looking at Haven assets definitely dipping, gold and the dollar edging lower. Consumer companies and banks leading a broad advance amongst European stocks. Now, coming up next, we talk about President Trump and, of course, his illness with Robin Niblett, Chatham House director. We talk about the elections. And, of course, we can not talk about Brexit. That would be amiss. So we'll talk also about sterling. This is Bloomberg.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
It's been a very interesting journey. I learned a lot about COVID. I learned it by really going to school. This is the real school.
We need to have trust. We need to trust that what they're telling us about the president's condition is real. We have to have confidence in the judgment of the doctors who are treating him.
Look, he's doing very well, and just like it could happen to anybody, but we're prepared. Look, we have a great vice president. We have a government that is steady.
His spirits were great. He was in a great mood. He was as direct and candid with me as he always is, and it was a great conversation.
An extraordinary weekend in the United States. Team surveillance, frankly, rested as we watched the news after an extraordinary and indeed historic Friday. Placing it into perspective now, Robin Niblett of Chatham House in London, of course, he's got a wonderful team looking at U.S. politics. Robin, what was the distillate of the Chatham House U.S. political team over the weekend? What did you learn from Leslie Vinjamuri and your experts?
Well, I suppose what we learned is that this election remains very open, for the simple fact that each time you think a particular bit of news is going to push it in one direction or the other, the counter-reaction to the situation then creates a new dynamic. So you would have thought, as we'd all noted, that the fact of the virus now hitting the president himself after he had dinged Joe Biden so aggressively during their presidential debate would knock him backwards. But actually it's given the chance to the president and to his campaign to put even more focus on him and his profile. Now, for those who think more focus on him is going to be negative, you've got to look at the fact that this just kind of brings his support base even more strongly into play. So I suppose from our perspective, we don't see this right now as a game changer in terms of pushing the polling in one direction or another. It is simply another wave, another dynamic of how each side's base gets more furious with the other side's base.
Right. Robin, if an election is a mandate, if we are out in March or April or May of next year with President Biden or President Trump, what will they be doing? Don't we just assume if I'm elected, free beer and there'll be massive stimulus?
Look, I think if President Biden is elected, the potential for heavy stimulus is higher. I mean, it's maybe an obvious statement given the kind of pledges he's been making on his campaign. Of course, a lot will depend on what happens with the senatorial races that take place at the same time. If Biden were to win strong, popular vote, but also electoral college, that would be telling you that the Senate would likely to be may swing in his direction as well, in which case the capacity for a big stimulus is larger. I'm less convinced that you would get as big a stimulus if President Trump were to win his second term. So I think you're going to look at actually quite a different approach. Ironically, from what I'm reading at the moment of of Joe Biden's push at the moment, is that he's looking for a much more inward outwardly focused kind of America. I mean, it's ironic we had a Make America Great Again push under under Donald Trump. But actually what you're seeing in Joe Biden's position is a focus on U.S. companies, U.S. workers, tax breaks for people to be able to keep things at home. I mean, this is a lot like what we heard at the beginning, on economic policy at least, of the Trump administration, which then didn't happen.
Robin, just to go back to the election, and then we'll go, to talk a bit more about some of these economic policies, but how close are you expecting the election to be?
I suppose my ranking on this is close win for Biden to large win to Biden to close win for Trump. Now, I'll be proved wrong, but there's no point working at a policy institute if you aren't going to stick your neck out a little bit. I think that the most likely outcome at the moment is very close. And there's some polling data I was looking at this morning showing only a 2% polling lead for Biden on the popular vote at the moment. So honestly, I think this remains incredibly hard to vote. If you look at what most people think, voters who they think is going to win, you get President Trump leading on Biden on the kind of popular sense of who's likely to win. You ask them who they're going to vote for, it looks like Biden's going to win. So honestly, I think this is going to be, my bet would be a very close election, and it could go either way.
Robin, if we look at foreign affairs and actually some of, the threats of tariffs that President Trump has put on China, but has also threatened Germany with, does a second-term President Trump become much more belligerent when it comes to starting trade wars?
I take a contrarian view to this. I think that if there were to be a second Trump administration, I think the desire to start to show that that the hard talk of his first term, at least in terms of foreign affairs, is starting to pay off, will be more of his dominant instinct. In other words, try to create the deals. And remember, other sides will have to do deals with America. Right now, even the Chinese are hanging back, waiting to see what happens with the election. If you have a President Trump in a second term, the need to compromise on America's counterpart side will rise. And I think the desire for President Trump to show that this paid off, and the desperate desire to be able to get some type of additional stimulus into the economy from a conclusion to trade deals, would mean we might see a less belligerent approach on trade at least. Now, the president may want to do that, as we've seen with Russia policy, where he wanted a more accommodating stance. Congress took that approach away from him and took a much more belligerent stance. So I see China being remaining in the very difficult pile, because even if President Trump wanted to do a deal, it'd be difficult to do it. But on Europe, I think you would see deals being done.
The deal's being done. I mean, it comes back to a transatlantic new foreign policy. Is the foreign policy of a two-term Trump the same as the first term? Why not?
Look, no one expected the first-term Trump foreign policy to play out quite the way it did. There's one thing we know of President Trump, is he will surprise you at every corner. The Trump brand, is something that is probably the most important thing to a President Trump. And in a second term, that brand has to live on beyond his time in office, has to live on for his family, for his kids. And he's not going to want to, go down guns blazing into the end of his fourth term with creating problems for the whole world. That's my read. Maybe I'm being too rational here. But I think that the chance of some things being different. Now, on the culture wars, hey, I think it'll carry on the way it is. On environmental policy, it'll carry on the way it is. On deregulation, it will carry on the way it is. But on foreign policy, on that outside side, I would see some room for compromise, especially on the transatlantic space.
Robin Niblett, thank you so much, and we will continue with Dr. Niblett here this morning with Chatham House on an eventful Monday, to say the least. We're looking for the news flow out of Washington. It's really not there yet this early in the East Coast morning, but somehow I think there will be a flow of news through the day, and please stay with us through all of this Monday. With our first word news in New York City, here's Ritika Gupta.
Thanks, Tom. Health briefings have offered false or misleading information about how President Trump is being treated for the coronavirus. That's raised questions about his condition. One doctor says the president could leave the military hospital in Maryland today. Still another disclosed that the president had received supplemental oxygen. Plus, he's being treated with a drug that is usually used for more severely ill patients. Meanwhile, President Trump paid a surprise visit to supporters of his who had gathered outside. He left the hospital to visit them. Video showed the president being driven in an SUV while he wore a mask. The mayor of New York City will close businesses and schools in 9 neighborhoods because of a rise in coronavirus infections. Bill de Blasio says the school closures in parts of Brooklyn and Queens will start Wednesday for an initial period of 2 weeks. They could then be extended. And it is a grim milestone for California. Wildfires there have burned a record 4 million acres since the start of the year. That's more land than was blackened the previous 3 years combined. Fires in California have killed 31 people and destroyed more than 8,400 homes and buildings. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. Now, coming up, we talk competition and we talk commission with the EU Commission Vice President, Margrethe Vestager. That's at 11 a.m. in New York. That's 4 p.m. in London. And this is Bloomberg.
You see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, the UK and the EU have entered a make-or-break phase for a Brexit deal. I feel, Tom, like I've been saying that for the last 2 years, but this time it's for real.
So?
After Boris Johnson and Ursula von der Leyen spoke on Saturday. Now, the two sides are nervous about key disagreements over fishing rights and state aid. Well, still with us is Robin Niblett, Chatham House director. Robin, I mean, we joke about it, but it does feel like, you know, it's always a crunch data. It's always negotiations on the brink. Is this time different, or are we going to have a last-minute agreement come November?
Well, it's different in the sense that on January 1st, the UK exits the transition period and border arrangements go up. Whatever happens, they'll either go up with really serious tariff implications for certain parts of the British economy if we do not do a deal, or they'll go up with pretty much open tariffs and a slightly smoother approach if we do get a deal. So the one thing I'm saying is this crunch will not continue. The crunch will be done one way or another, in the next few months. Now, will we get a deal done before the October summit, 14th, 15th EU summit? Unlikely. Will there at least be ability to use that summit to try to close off some last positions? I think yes. I think, look, the European Parliament needs at the very least to ratify this. I think as long as a deal is done by the end of October, early November, we should be in a position to get everything sorted out by the end of the year. But that means that these next few days are absolutely critical, because Boris Johnson cannot afford to go beyond the middle of October knowing whether a deal is likely, because if it's not likely, he might as well stop negotiating now and start getting the country ready for a very bumpy January.
Robin, I remember as a young reporter 15 years ago in Brussels, being told to always look at fisheries. It's something that we don't do very often, looking at fishing arrangements. But actually, is this a real sticking point? And will it be up to France to decide whether they give up some of their rights in fisheries?
It's definitely a real sticking point, because this is where people are in a zero-sum situation. We talk about whether tariffs are at zero, quotas, rules of origin. The impact of these changes will filter through slowly to people's pockets or to companies' bottom lines. But if you lose access to a fishing ground and you're a fisherman, fisherwoman, that is immediate in terms of a loss of income. And so it is the most pointed, even though it accounts for a minuscule amount of both the EU's and the UK's GDP, it is a real political issue. It also has that kind of border quality to it. Where do my borders start? Where do they end? It's totemic. So you're absolutely right, it's real. The problem we have is that the UK wants to take back full control over its fisheries waters, and from the beginning show to UK fishermen, an important voting bloc for Brexit, that there will be immediate benefits to what they can catch. The problem is what they catch and what Britain sells to the EU is we sell most of our fisheries exports to the EU. So if we were to collapse the deal to protect British fishing waters, the irony would be we wouldn't be able to sell as much fish to the EU. So it's a very complicated position. The UK, as I said, wants to go back to controlling those fishing waters. If they do, French, Belgian, German, Spanish fishermen will lose out.
I mean, Robin, this is a great conversation. The closest thing I get to fish when I go to the United Kingdom is buying the full sturgeon at, the whole sturgeon piece at Harrods. I mean, that's as close as I get. Actually describe this for the American audience waking up this morning. Is this an argument about the North Sea? Or is this about, boys with little fishing lines in the English Channel with the red and white bobbin going up and down in the water? Where is this exactly happening?
It's more than, it's the North Sea, most definitely, that broad area of water up, let's say off the northeast of England, cutting across to the Belgian, the Dutch coast, but it is also the Channel. So it is literally back to, I wouldn't say armadas, but you're onto the French coast and the British coast, that very narrow channel where just recently there was a real ramming of boats about 6-9 months ago, where French fishermen felt the British boats were getting too close to some of their catches. You've got the Channel Islands, which have British territory, which have their own fishing zones around it, very close to the French coast. So this is not just a North Sea cod thing. This gets right down to the French coast. As we know, French fishermen, like French farmers, are some of the most vocal and physically active in defending their rights. So, the thing about fisheries is it brings the whole reality of Brexit, like the Irish border does, by the way, into where does sovereignty begin and where does sovereignty end? And, this is what people have been trying to hide under Brexit, under talk of rules of origin and voting rights on governance and dispute settlement mechanism. You can't hide fish. Fish is real.
I am speechless. This has been wonderful. This is the highlight of the week, and it's only Monday. Robin Niblett on the fishing dynamics of the United Kingdom. Francine, I learned a lot there. That was really good.
Yeah, look, it's all about the fish time. It's true, we don't speak about it, enough, but this makes or breaks an industry which is close to both countries' hearts. Fish is real.
Fish is real. It's all over the Guardian today, and Al Jazeera's written it up as well. I mean, this is, we're going to put it, I'm going to get it into the data check. We're doing it at the top of the 6 o'clock. The price of cod in the North Sea, an important data point. Now they're Bloomberg Business Flash, fish free. Here's Ritika Gupta.
Thanks, Tom. Francine. ExxonMobil's plans for an increase in emissions has been revealed in leaked documents reviewed by Bloomberg. They show the energy company expects to boost carbon dioxide emissions by as much as the output of the entire nation of Greece. It comes at a time when Exxon rivals such as BP are moving to curb emissions. Exxon calls the documents an early assessment that does not include abatement measures. Drug makers are under pressure to come up with a vaccine for the coronavirus. There may even be more urgency following the news that President Trump had contracted the virus. Johnson & Johnson CEO Alex Gorksy spoke with Carlyle Group co-founder David Rubenstein.
I think it demonstrates that we're all vulnerable, and we still all need to be very vigilant and diligent in the actions that we're taking to prevent this virus from spreading any further.
You can catch more of Alex Gorsky's exclusive conversation coming up this month on the David Rubenstein Show, Peer-to-Peer Conversations. And that's the Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. Now, up next, we speak with Stephen Riley, Imperial College London professor of infectious disease dynamics. We'll talk lockdown. We'll talk about what's happening in London, Paris, and New York. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
At this time, the team and I are extremely happy with the progress the president has made. Thursday, he had a mild cough and some nasal congestion and fatigue, all of which are now resolving and improving.
Right now, he is not on oxygen.
I know you keep saying right now, but should we read into the fact that he had been previously?
Yesterday and today, he was not on oxygen.
So he has not been on it during his COVID treatment?
He's not on oxygen right now.
This weekend's festivities in the United States of America, science lesson for all. Many people outraged, other people less so, by the illness of the president, the action of his medical community at Walter Reed. Again, our team in Washington is waiting for information from Dr. Sean Connolly and his team over whether the president will be able to leave Walter Reed today. We have been so advantaged by experts in science, and one of them is Stephen Riley of Imperial College. He is truly one of the world's experts is how these viruses move around. Stephen, I guess I should talk about Washington and this focus on the president, but we have breaking news out of France as they really, as a city like Madrid last week, begins to try to deal with a virus. It reads like Albert Camus' The Plague. Is Paris doing the right thing to lock down, or as Francine mentioned moments ago, to restrict their society?
I think you've got to break it up into two parts. If the number of infections is going up, that's going to cause hospitalizations. The French have a very clear system of metrics and warnings. They're approaching too many people in the intensive care units in Paris. So they are making a choice that they want to reduce the number of infections. After you've made the choice, the question then is, what is the best way to do that? Because we've got a range of different policies that we want people to comply with to the best of their ability. And if compliance is not high enough, then governments are choosing to bring in more strict and direct measures. So I think that the decisions that I'm seeing come through, about Paris make a lot of sense to me, and it's really a direct question for the people of Paris, whether they support that going forward over the next. I think it's decided for 2 weeks initially, so it's a decision for them really.
Hey, look, excuse me. I'm sorry, folks. Yeah. I'm looking at the Nobel Prize coming out in medicine. Francine and I are looking at it in real time as we go. I mean, Stephen Riley, you look at these cities and just the ability to contain the pathogen. I think the president now is a loyal mask wearer. I would believe that's the case. Give us an update on Stephen Riley and the mask. What do you tell your family? What do you tell your neighbors?
So if in the UK, we've got a very kind of clear policy. If you go into a shop or pretty much an enclosed place with people that are not in your bubble, then you should try and wear a mask. So we take a mask with us, and whenever we go into a kind of an enclosed public space, then we wear masks. And I think that's the right thing to do. I think they have some demonstrated benefit in blocking the virus as it comes out of your mouth. The science on them actually being able to block the virus, is clear. But more than that, they signal that you're taking all the other interventions seriously, and they signal that you're acting in a way that you're trying to protect the people around you.
Professor, are we measuring the number of people infected correctly? I know there was discrepancy between the amount of people we test, and then if you do randomized tests, because some people can also be asymptomatic. So how bad right now is it in London or Paris? Are we doing the right thing to just have an idea of where it's spreading?
So I am involved in one of the major studies in the UK, the REACT study. I'm spending a lot of time on that at the moment, and we randomly recruit people. We send them a letter, we then send them a swab, and we test those swabs. And that's showing 1 in 200 people kind of currently infectious with the virus. Those data are really important and very and allow you to interpret the other data streams much more clearly. So I don't believe similar studies are underway in a lot of the other kind of developed countries, and that's a good point. And I would encourage other countries to consider the potential value of that type of approach.
Too short a visit. Professor Riley, thank you so much. Stephen Riley of Imperial College. There is a Nobel Prize to 3 physicians on the cure of hepatitis. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
This morning, the president's blood oxygen saturation level, it rises. Stocks as well as markets calm. Gold weaker, the Swiss franc too. Road trip, Mr. Trump, he visits supporters in the hermetically sealed presidential SUV. Uproar ensues. He wants to exit Walter Reed today. And with 29 days to the election, Mr. Trump yearns to return to the hermetically sealed campaign trail. Mr. Biden adjusts his message. There are 10 days to a scheduled Miami town hall debate. Good morning, everyone. This is Bloomberg Surveillance from New York, from London as well. The pandemic in Washington. We'll talk to Martin Schenker about there in a moment. Francine, those headlines out of Paris just showing every city for themselves.
Well, the fact that actually it's very difficult to keep control on this, despite extra restrictions in Paris, is something that a lot of major, cities, big cities especially, will have to grapple with, be it London or New York or other countries. So we're watching to see what will happen in Paris. We're, of course, watching the health of the president, Tom, after a pretty, bizarre, frankly, weekend where it was difficult to understand how sick or how not sick the president was, and that's filtering through the markets.
Well, conflicting stories there at our Washington team, waking up there into the chaos of Monday, and we'll have some clarity on that, no doubt, through the morning. Let's get to the news with our first written news in New York City. Is Ritika Gupta.
Morning, Tom. Francine, there's confusion over how President Trump is being treated for the coronavirus. In public, his doctors remain upbeat. One says the president could be released today from the military hospital in Maryland, where he's been since Friday night. Still, another one said the president has been given supplemental oxygen and he has received medication typically used in more severely ill patients. Meanwhile, the president unexpectedly left the hospital to greet supporters who had assembled. He waved to them from his motorcade in a bid to demonstrate strength. Joe Biden leads President Trump by 14 percentage points in the new Wall Street Journal NBC News poll. Biden's 53-39 lead is the biggest of the campaign. Voters were polled after Tuesday's debate, but before the president was hospitalized for the coronavirus. In the UK, Prime Minister Boris Johnson is warning the public that a, quote, very tough winter lies ahead. Johnson said he accepts that people are angry with the way he has handled the pandemic. He told the BBC that it's going to be a bumpy ride to Christmas, and it may even be bumpy beyond that. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine Tom.
Hey, Ritika, thanks so much. A lift to equities. Futures up 20. Dow futures up a good 164 points. The levels are 33.59 on SPX. Dow 27.729. The VIX starting to give me a better price. 29 comes into 28.96. In the yield space, yields higher. Big higher, 30-year bond out, 3 basis points. That's an 11 basis point move over the last number of days, 1.52%, and the 30-year bond exploding rates higher. Francine?
Tom, I'm looking at yen retreating. I'm looking at treasuries pretty much steady. Overall, consumer companies and banks are actually leading this broad advance amongst European stocks. And then I'm also looking at pound. You can see 129.50 as we really enter, 2 weeks of intense negotiations with fisheries left, right, and center.
Yeah, really something to see the arguments about across the channel in the North Sea. And we mentioned also the Paris news as they continue with the bars, I believe, closing on Tuesday as well. Joining us now, our Chief Walter Reed correspondent, Martin Schenker, joins us. He spearheads all of our editorial coverage, which means he had a wild 9-day week last week. Marty, Friday didn't end. We went right into Saturday, right into Sunday as well. Give us an update from Craig Gordon and the team of what to expect this Monday.
Well, I think you have to expect the unexpected. That's been the trend in this presidency for 3 years, and we don't expect anything different. So just when you think you know what's going to happen, something happens that takes you in a completely different direction.
Are his doctors in control? What is the estimate of our team?
Well, actually, because of the inconsistencies in their reporting on his condition, it's very hard to get a handle on exactly who is calling the shots. But I suspect it's Donald Trump. I mean, the whole notion that
Marty,
he could
come on. Marty, I'm going to stop you right there.
Okay.
How does a 74-year-old patient, I don't care if he's the president of the United States or whoever, how do they control the situation on a medical condition?
Well, if Donald Trump says, I want to leave the hospital, and it's against the advice of the medical team, the real question is that going to be disclosed to the public? And so far, the medical team has suggested that the narrative Trump wants out there is the narrative they're going to give, regardless of his medical condition.
Marty, how is that playing out in the polls? Is there a sympathy vote? Or are people mad that, he was in a car, for example, whilst having COVID-19 with Secret Service driving it?
Well, it's really interesting. You saw over the weekend the polls, the NBC Wall Street Journal poll showing the widest Biden margin in the campaign season, but that poll was taken before Donald Trump's diagnosis. We're anxiously awaiting the poll data that will be coming out probably at some point this afternoon on post-diagnosis. There might be a slight sympathy bump, but there also might be the thought that, well, why would we vote for this guy who has, flouted the rules on social distancing and mask wearing? So it could cut both ways.
Marty, how sick is the president? How much do we actually know about this? Like, who do we trust? Or are we going to be briefed today? Can we trust the person that's briefing us?
Well, what we and other news organizations are forced to do because of the inconsistencies among his aides and his medical staff on his true condition is we're relying on sources within the White House who are giving us information on his condition. And it's really unclear just how sick he really is.
So, Marty, I know this is all speculation. Vice President Biden, I assume, will campaign today. Does he campaign today like he campaigned on Thursday?
I think he's going to continue to campaign the way he has been doing it in the past, which is, as we all know, has been without contact with people with severe measures to make sure he doesn't come in contact with anybody with the virus. So, and he's playing up that contrast with Donald Trump just by doing it that way.
Marty, how's the First Lady doing?
As far as we know, she's doing fine on mild symptoms. She's not been hospitalized. And, that's a question that I wish someone would put to the doctors. What is the difference between Donald Trump's condition and Melania's condition that forced one into the hospital and the other not? But apparently she's doing pretty well.
Marty, I mean, this is a question, that we try to get through every day, actually, with Johns Hopkins experts, and for the moment, it's something that has still baffled, actually, a lot of doctors. How much focus will you put on the vice presidential debate, and could that really move the needle in terms of voting, or are people pretty much entrenched? There are fewer undecided voters maybe than in the past.
Yeah, I would think that it's going to be just more theater than substance, frankly. Vice presidential candidates traditionally don't move the needle in terms of support for the candidate at the top of the ticket, and I don't think the debate's going to make much difference either.
Marty, a difficult question. Do we know, what we know about the virus is that it can take, 5 to 14 days to actually develop symptoms or to get sick when exposed to someone who has COVID-19. What's the level of angst in the White House? I mean, how many people are getting tested, but also on the Democratic side, given we had that debate last week where, the two candidates were not close to each other, but there was a lot of shouting and possibly spitting?
Yeah, there have been a number of calls over the weekend for Congress to begin a testing regimen. Right now, there is no testing going on in a systematic way on Capitol Hill, even though they're gathering together. I will say that in Donald Trump's case, the idea that he'd be discharged this early in the diagnosis, when, in fact, as you say, that it could be days before symptoms really get serious, is, to me, very troubling.
Marty Schenker, one more question, if I may, off of that poll statistic. And 39 is a lot different than 40 or 41, just psychologically, in terms of the president's polling. Boy, does it harken back to the senator from Kansas and the governor of Arkansas just a few years ago. Mr. Dole and Mr. Clinton, in that election, we showed up and we got exactly what the polls delivered. Is it the same this time?
Well, it's beginning to look that way, Tom. I'm not willing to make a prediction, but certainly if you're Joe Biden, you're a lot more confident this morning than you were Friday. So you very well could have a Biden presidency.
A terrific Monday brief from Martin Schenker, our Bloomberg Chief Content Officer, this morning. Coming up, this is a really important and sophisticated interview. The always sophisticated Charles Evans, he of Chicago. Look for this in the 11 o'clock hour. He is extremely bright on this idea of reflating a nation and an economy. Really looking forward to this conversation. Stay with us with Futures Up 17. This is Bloomberg. Good morning.
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We're still apart on our asks. They're, in our judgment, asking for a lot of extraneous things that have nothing to do with COVID and the economy. The split has narrowed somewhat, but it's still wide enough.
Mr. Kudlow, with a challenging Friday and into the weekend as well, of course, the economic advisor to the president, speaking with Jonathan Farrell. Always a nice tradition for us on Jobs Day. Right now, a tradition after Jobs Day is to mop up with an 11 basis point move in the 30-year bond. Oh, the humanity could have been his research note this weekend. James Karen joins us. Jim Karen of Morgan Stanley, and of course, with real money at risk. There's that horizon function, Jim, on the Bloomberg. You know it. I think it's HRZ or HZ as well, which means yield up, price down, bond portfolio losses. When do you sweat?
Well, you know, I think you can start to be concerned, but I wouldn't start necessarily sweating. I think we still have to look at the Fed for guidance. And so far, what the Fed has told us is that they're going to keep interest rates low for a really, really long time. So the only thing that can really move the only thing that can move bond yields higher is inflation expectations. So if you look at 10-year break-evens right now, they're at about 165 basis points or 1.65%. Real yields have tips yields have been going a little bit lower. So I think that's the push. But I think what's really behind this is that I think with the, with the president, coming down with COVID, there's some thoughts that we may get a little bit closer to a stimulus package coming out of Congress, not necessarily before the election, but maybe sooner rather than later. And if we follow what's going on in Europe, the last time that Europe started to spike, it wasn't long before the U.S. started to, start to see some spikes themselves. So we may be a little bit behind them. So that might be some motivation, too, for a stimulus package.
What is your portfolio mechanics right now on duration or maturity? What dynamic on the x-axis do you have of a given bond portfolio?
Yeah, so the way that we are looking at things is that we are long duration. So we have some long duration exposure, but that duration exposure is kind of mixed into high quality investment grade credit mainly. So where we stand is that we do own some government bonds, G3 government bonds for protection and safety, but we also own very high quality investment grade to get some additional yield. So we do think that owning some duration here makes a little bit of sense. But you can also mitigate some of the duration sensitivity to your portfolio by owning a little bit of credit and almost having a bit of a barbell, if you will, to get some income from yield and spread, but also some protection and safety from the duration of high quality bonds.
Jim, what are you expecting, what are the markets actually pricing in at the moment? So are we expecting a lot of volatility into fourth quarter because of the election, because of COVID-19, the number of infections rising? And then could an economic rebound actually surprise us in 2021? And is the market positioned for that?
I think that is that's exactly the whole point right now, right? So the issue at this time is that there's a lot of volatility. There's a lot of expectations that the markets could get volatile and that there could be a dip. But people want to come in and buy that dip. Why? Because there's a lot of money still on the sidelines, and some risk is being taken out of the market at this point in anticipation of this volatility. But if we have a decisive winner of the president in early November or shortly thereafter, I think there is going to be a rebound. So at what point does the market look through this volatility that we expect to happen in the fourth quarter and then start to price for the first quarter of 2021 and beyond. And don't forget, 2021 is supposed to be a much better year in terms of economic activity. It's a rebound year with all of the stimulus that we've put in 2020. So I think that's absolutely the key is you don't want to miss out on an opportunity to the upside, but at the same time, you don't want to get hurt too badly if there is a very big volatile event that drives prices down in the near term.
But Jim, would an economic rebound be strong enough to bring inflation with it? And what does that do for the Fed?
Yeah, well, I think the Fed's going to ignore the inflation for now. And I think that's what they're telling us loud and clear, is that they want to reflate. Tom was just talking about Evans speaking about reflating the economies. Look, I think there's a bigger backstory here, and I think it's important that we get a hold of it. The successful policy, whether it's a Trump administration or a Biden administration, in 4 years' time, when we look back, is going to be which economic plan, which candidate's economic plan can start to break secular stagnation, which is just lower and lower growth with more and more stimulus that leads to, that doesn't really lead to inflation. So in the Biden camp, what we see is much more of a fiscal spending thrust, much more of government spending. So as you were mentioning earlier, Biden's ahead in the polls. That's showing up in the bond markets. That's one of the reasons why bond yields are rising, because we expect more of the fiscal spending and government spending. On the Trump side, it's much more about the private sector. And the private sector tends to have a little bit more efficiencies and probably less fiscal spending. So therefore, you don't get as much of an inflation surge. But either way, what we're starting to see is productivity and CapEx and investments start to rise, which means that you can start to get good growth with low inflation. But to the extent that you get a bigger boost, like a stimulus package or fiscal spending, that can start to put more people back to work very quickly, that's going to increase inflation expectations. So I would argue that under a Biden presidency, that inflation expectations can probably rise a bit more. And since he's polling, very strongly in the polls at the current moment, I think that's being reflected in the markets.
Jim Caron, thank you so much. I have to leave it there, but a nice brief this morning here again with a 30-year bond, 1.51%. He is with Morgan Stanley. One of the things you learn as you wander through an undergraduate curriculum is there is something miraculous about the muscle of the heart. It is simply different. Bristol Myers will pony up large for a company from San Francisco with under 300 employees. It is myocardia. And they are hyper-specific to the study of heart muscle. This is a really, really interesting acquisition with a huge premium. I believe it's 61% out to 225-ish is my recollection of the press releases running by. But what's really interesting here is the science. This is a giant drug company going after massive specificity over simply the protein dynamics of the heart muscle. Really, really interesting, unique transaction. Later today, talk about big